Okay, I think we're getting ready to start, everyone. Smaller crowd this morning. Hopefully everybody else is working on their presentations. Okay, this morning is going to be maybe an area where many startup entrepreneurs prefer not to have to spend time, but it may be the very most critical areas for you to understand and listen to. Because in the end, it's about building a successful business financially. Over the first 3 days, you've heard about the general things we look for as investors. I'm going to repeat or reinforce some of those points. Moses did a great job getting you all energized and talking about agile development in day 2. David did a great job yesterday with one of the most, if not most important areas, is developing the customer base. Without customers, you don't have a business. And many startup entrepreneurs are engineers, so they tend not to want to think about that, but you must. And as I said earlier in the week, you must spend 70-80% of your time up front getting out and talking to prospective customers, because they're going to give you invaluable feedback to improve your presentation. Hopefully you got some of that out of what we've done this week so far. But we want to work today to really solidify some points. So I'm going to start, get everybody brain working this morning. Let me raise your hand and tell me what you think are the top 2 or 3 things you've learned so far this week that you've been able to integrate into your thinking and your presentation. Wait, oh yeah, go ahead. Please, yeah, use microphone so everybody can hear.
Yeah, gross margin is most important thing, one of the most important thing to survive and then accelerate in LTV and CAC. Without considering those 2 digits, you will be killed very soon.
Exactly. And understanding what gross margin is, because there was some confusion, and I'm going to talk about today even what it means to be gross margin. So I'll come back to that point, because it's very critical. You must have large gross margins to make your business cash flow positive as soon as possible and a success. And again, I'm going to talk about that. And I know it's going to be some areas, like I said, that most of you aren't accounting oriented. Some of you are, but it's a very important point. Another point. Any other points? Wait, please use the mic.
Okay, so I've learned a lot of things here, but the 2 main things I've learned is that the customer experience is the most important thing. So we are making a product not the way we like it to be, but the way the customer wants it to be.
Exactly.
So we have to change the product according to what the customer wants. And another thing is that during the pitching, you're not talking about what you're creating, you're selling what you're creating. So you have to change the whole pitch according to the selling point.
Exactly, exactly. Yeah, and to reinforce that again, don't think you know what your customers want to buy, because you probably don't. That's why you must go out and talk to customers early on. You can almost not spend enough time talking to prospective users or customers of your technology. Very, very important point. It's the point that the biggest error, and I'm going to talk later about why do startups fail, and I'm going to do that because it's easier in my mind to comprehend when something goes wrong than why something went right. So that's a very critical point. Yes?
One thing that I learned is to say thank you for a quick no. It's really hard for Georgians to say thank you for no.
Exactly, exactly. Great point, great point. Another one? One more, 1 or 2 more. In the back.
First of all, thanks very much. I have received a lot of... I was working in Europe, and it's absolutely quite different between European style and this American style. And for me, it was that I have catch this most important for me, that go global. What you are just now pushing us to think in this direction. In Europe is go on nation level. It is mostly restricted. They that I was working in Germany, in France, in Italy, all of them in nation level. They are not such European level mentality on that. Now you have much more global, not American, but go global. My God.
Sky's the limit.
Yeah, and I am really have received a lot of thanks.
Great, that's great, great. It really is. And by the way, it's not wrong. In fact, many of the startups that didn't make it to this round of 50, we thought actually have potential as regional businesses, but they're not as strong potential to be a global business. So that's why you're here, and that's why they're not here for this session. So really think, and going global also means raising capital globally. Hopefully at some point, the best of you that your business has taken off through the funding you'll get now will have a chance to come to Silicon Valley and raise a much bigger amount of capital. And then you'll be on your way to becoming that billionaire that the Mark Zuckerbergs of Facebook will be your opportunity. One more? Yes?
I've learned that there is always something that you can improve in your speech and all your project, and also that you can get good advices from unexpected sources.
Great, great, excellent, excellent. One more? Okay, we'll give one more.
So I have learned that the most important thing is to make research, and more research for saving your money and time.
Yes,
That's
you almost can't spend enough time understanding your competitors, understanding what your customers really want. Both are absolutely critical. Okay, we got one more. This is great.
The most important, I learned that you need not to be a personal connections to the speech and other stuff. You need to develop, and move on. Just
Right, repeat. So
yeah, and not subjective and like.
exactly. So I actually had an opportunity to play in the National Football League in the United States. And it was, you see the glamour on the television show, but it's all about repeat. So you do things perfectly when you're on the field. And that's what the athletes at the Olympics are doing right now. You have to constantly work to improve, and you're never done improving. So it's a constant process. I was a tight end, if you know. I had to block guys a lot bigger than me, and I had to run fast. It threw guys a lot faster than me. Okay, now let me flip the question. So today I'm going to hit on a lot of issues, but I want to ask, is there any areas that you'd like us to maybe expand on a little more? Because I'll take an opportunity to do that as I go through my pitch. Anything where you're still not sure and you'd like some additional feedback on? Any general points? Yes.
What probably could be interesting for most of us here are common or recommended, how to say, approaches to manage the equity participation of the co-founders in a dynamic way while the company proceeds. I think this is a very important issue, and especially from the Silicon Valley experience, you know that this is.
That's a great point, and it's something I'm specifically covering in the Why Do Startups Fail? Because if you don't get the people and interaction of the team right, your chances of success are much lower. Any others in the front?
I think one of the topics that we did not cover over the past several days was the burn rate and its importance in the startup.
Absolutely. I'm going to very much touch on that. That's the financial part of the business, and that is incredibly important. So that's today's primary topic, or one of the primary topics. Any others? In the back.
Yeah, and I will agree with Nicholas. And also in financial parts, market entry fees, for example, and costs. So it's more in financials.
Yeah. I'm going to go into that in depth, maybe even more than you want to. Okay, in the back.
Also, I would proceed with the shareholder agreement. Once you, for instance, succeed, and there is a point that you could accelerate another country. For instance, we have same situation in our startup for Estonia. We don't know. We know, but we have some concerns how to defend our startup interests in front of other country penetration situation. What would be the issues? What would be the shareholder agreement terms and conditions what percentages is it better to give away, to receive shares in new venture, or it just to plain have income, EBITDA based income?
Yep, great question, and it's again and exactly one of the key points that I'm talking about today. Over here in the front. Sorry? Yeah, I'm going to talk about the whole shareholder value, cap table, equity ownership.
Hello. Maybe for us it will be also really important to mention, and if it is important to mention in the presentation about the exit strategy.
Yes, that's another point I will hit on. Absolutely. In the back.
Please, I'm really asking you to give us your idea about your criteria, because we want to find out our weak and strong sides, because we have received 5.9, this estimation. Where we have weak, where we have strong. We must just now somehow self-improve.
Yes.
That's why we really need your criteria of estimation. Thanks.
There's a great book, if you want to take a note on this, and it's ageless. It's been around since the 70s. He's done a revised version for the modern era. The author is Michael Porter, P-O-R-T-E-R. The book is called Competitive Advantage. And what it talks about is, how do you analyze for your strengths? How do you analyze and offset your weaknesses? How do you look for opportunities? And how do you deal with threats from others? SWOT, S-W-O-T. If you remember that, that's the analysis. Any others? Okay, great. I'm going to jump in then. And please jump out, raise questions, stop me. So hopefully by now you know who I am. The agenda today, my background, Silicon Valley overview, the basics of how VC work, the financial modeling. It's like you must have all read my slides before I put them up. And why startups fail. And again, I talk about that because in my brain, I always find it's very hard to understand when something's a success why it was. Because it's usually a bunch of things. But when something fails, my brain at least understands explicitly why it does. So that's, I'm going to talk about why they fail, and therefore think about don't do those things or offset those things. Okay, I've done my own startups. The last one I sold to Cisco last year was an IT security company. I did an underwater robotics company, and if you ever travel internationally, your luggage gets checked by the machines that we developed, excuse me, for most international airports. I've been in both corporate and institutional venture capital. And now I'm president of Global Visions, which is a forum that brings together support resources for folks like yourself and invests in startups. Silicon Valley. If you don't know much about it, it's all about job creation. It's the center of the universe. Last night, we were having a discussion with some of your senior government officials and fund managers. If you understand what GDP is, gross domestic product, it's how fast an economy grows. Silicon Valley has had the fastest growth of economy anywhere in the world, double digits, whereas on the world average, it's 2% today. And it's all about the innovation and the job creation that happens there. There's more than 10,000 companies headquartered there. They employ over 1 million people. It's about wealth creation. That's a good thing. Publicly traded companies have over, from market capitalization standpoint, 1.4 trillion, that's with a T, not a B or an M, dollars worth of market capitalization. It's all about being entrepreneurial. It's all about understanding. We've had 3 generations. Venture capital started in the late 60s in Silicon Valley. We've made all the mistakes. So what we're hoping to help you do is not make those mistakes and maybe even leapfrog ahead of, because you're more nimble now. It's merit-based. It doesn't matter what your lineage is, what your race is, what your sex is, your personality, it's all irrelevant. It's all about success. Oops. And then making money is not only acceptable, it's a badge of honor. But at the same time, and this is so, so important, failure is necessary to innovate. That sounds weird, but let me explain what that means. If you don't push the limits of the technology barriers or the business barriers, you won't innovate. But when you do that, sometimes you won't succeed. Failing in that sense is not failing, as long as you apply the knowledge and don't make the same mistake a second time. So it's actually a badge of honor to have companies where you may not have had great success, but the really famous ones have come back and have successes after that. Even Google, let me give you an example of Google. Google tries things all the time, shuts down businesses all the time. So they're not perfect, even though they've become one of the largest companies in the world. Remember Google Glasses? Went away. They misjudged the need in the marketplace or the timing in the marketplace. So learning from mistakes is what it's all about. And the Google environment embraces that and tells you that's okay. Don't make that mistake again. Come back with a better idea next time. Okay, so what is this thing called venture capital? There's several varieties of it. There's private, corporate, institutional, in relatively early stage companies. There are 4 variants of this. There are angel investors. These typically tend to be people like Mark Zuckerberg that are now investing in other startups or other high net worth individuals that want to help others be successful. There's crowdfunding. It's a new phenomenon. We were talking with your bank system just in the last couple of days to help them, and Geeta's actually spearheading this to try to change the legislation so that Georgia can do this more efficiently. Meaning anybody can invest through a website into companies and then they get share ownership in it. The difference between financial, or as it's called, institutional investing, and strategic, or corporate investing, I invest as an institutional investor today. In the past, I invested as a strategic investor with a corporation. So in that case, the company's balance sheet I use to invest in companies. But as an institutional, I get money from other parties. In the US, it's typically pension funds or university endowments that want to put money to work to get a return on their capital. And so they put a percentage, about 15% of their portfolios, into the venture world. So angel investors are typically wealthy individuals, tech industry background, usually by US standards a small amount, less than $1 million. Excuse me, I'm fighting a head cold. Oh, that's good. The motivation is a dramatic return on invested capital with the idea of either going public or selling to a corporate player. But they tend to come in very early because they're not going to be the ones. In the US, as an example, on average, there's a wide band, it takes $20 million to take a successful startup all the way through an exit. Some of them take quite a bit more. Uber's raised $4 billion with a B. Others have got there. Snapchat, I think, is a good example. 14 employees, sold 14 months after being founded for $1 billion. Rare instances, but they do happen. The angel is typically interested in technology and industries. You have several angels in Tbilisi that fall into that category. As I mentioned, financial, most common type of VC investment firm. We're taking money, sometimes from high net worth individuals, mostly from pension funds or endowments. Usually organized as a formal fund. It's typically a 10-year time horizon where we invest first in the first 3 years, then the best of those we invest again, double down, in the best of those in years 4, 5, and maybe 6. And then we're harvesting. We're helping to find exits or take those companies public in years overlapping 5 through 10. That's a typical fund timeline. Fund compensation, how do I get compensated? There's a management fee for helping you all be successful, and I get a percentage, or we as a team get a percentage of the profits from the sale. But most important, our investors make typically 25 to 30% return on their invested capital. So it's very lucrative for them. Fund sizes, typically as seed funds, you're going to see some of these next week, are in the 25 million range. because they tend to do smaller early stage. But there's one investor that will be here that is in a fund that's managing almost $10 billion. It's NEA. So broad range. Motivation, again, is purely financial. And again, IPOs and sales to large corporations. Typically, the strategic is a large technology corporation. Cisco invests. Microsoft's investing again. My company that I was at the time, SAIC, did this. Intel does this. A lot of large US corporations set aside a certain amount of capital and invest typically in startups that are going to help build their business long term. Siemens is another example, AT&T. Corporate funding is strategic in orientation. That means they're doing it because it's of value to them to build their own business or bring new innovation to their companies. Because, by the way, one thing, having been Oracle CIO, largest enterprise software company in the world, doesn't innovate anymore. When you get very large, everything slows down because you have so many layers. It's like a typical government agency, so many layers of decision making that they are no longer nimble. So they need to buy companies like yours or partner with companies like yours to be successful. So David and Goliath, David can and does win because the Goliaths know they can't be as nimble as David was when he threw that slingshot. They're not exclusively looking for a return on investment. It's more about the strategic fit and helping to fill what are called technology white spaces, gaps in their own capabilities that their customers are asking them to provide. And they may provide investees with valuable connections and partnerships. And last, they don't typically lead around. The institutionals tend to be the ones that lead, meaning take the lead on pulling together the deal, and then they follow more passively into the deal. And I'll talk about that more in a little bit. So what do we look for? You've heard this. I just want to reiterate it. Because your presentations, we were asking you to focus on these things over the last several days. You need to have a high growth market with strong margin potential. And I'm going to explain again gross margin in detail because there was some confusion on what that meant. Offering technology that is unique, discriminating, disruptive, game-changing. Uber did that in my driving to the airport. I happened to take a cab instead of Uber. And I asked the taxi driver, what's he thinking of Uber? And he said, we hate it. It's taken 70% of our business away. It's disrupted the taxi industry in Silicon Valley. Very important to have a proven management team or know where you have gaps and find ways to fill them with advisors. And we as investors, if we really like an idea, will help you fill those gaps. And the last one, as David talked about yesterday, a very, very well-conceived, well-thought-through go-to-market strategy. How are you going to generate revenue? How are you going to acquire early customers and then continue to grow over time? Remember those in your presentations. Focus on those 4 points because that's what those investors next week, and we're going to dry run it tomorrow with us simulating that. Focus on those points. Okay, you saw this, so I don't need to go through this again. But this is basically the construct of the outline of what's perceived as a preferred presentation template. Some modifications of this are perfectly fine depending on your business. But again, if you look at this and you look back at the last chart, you'll see that they map to one another. By doing this, you'll be addressing the issues that the VCs are asking for there. So that's why we give you that sort of focus. You've seen all that yesterday, so I'm not going to go through it, or the last couple days. Okay, now let me get to one of the points that was asked here earlier. I call it the stork dance. So I don't know if you know what storks do when they're mating, but they're dancing around the female, and they're looking to cooperate. I guess that's the best way to explain it. But the stork dance goes like this. We as VCs typically will see as many as 200 startups a month. 200 startups a month. That means we don't have time to spend with all of them, and if you don't capture us right up front with that elevator pitch, that I call it aha, where your first slide, you get my attention and I go, aha, I haven't seen it done this way before. I haven't seen this approach. Tell me more. If you can't get that, your chance of going any farther or having the interest, because we have 200 plus a month to look at, is very, very challenging. So, how do you get to VCs? The best way to get to VCs is through a warm introduction. You can submit through a website. Startup events are a good one. Gita's doing those here, of course, and they're in Silicon Valley almost every day. But warm introductions to someone that you know that knows the VC put you in a category of increasing your probability of even getting a meeting by an order of magnitude. And as your program progresses, one of the reasons we're bringing VCs here to judge is so you'll start building your own warm relationships with international VCs. So be sure to take the opportunity during the breaks to reach out to them all. Warm relationships are what it's all about. You will have to make pitches to 30, 40, 50 VCs before you're going to close a Series A or later round. 30, 40, 50. You have to understand, if you're going to do that, if you have the wherewithal to go through that, it's staying power. And that means you'll have 29, 39, 49 no's. But as I said to a couple of the groups, don't take that as a criticism. Take it as a learning experience. Ask them at the end of the meeting why they decided no. Sometimes the answer has nothing to do with your offering. Many times it has to do with they're at the back end of a fund and they don't have more capital to invest until they raise a new fund themselves. Or you're in an area where they already have a competitive solution and they don't want to invest in competitive solutions because that causes a conflict of interest internally for the partners in the firm because they can't talk to each other because you have to protect your proprietary offering. So the good news is you go to the websites, you find all of the portfolio companies, and if there's something there that's similar to yours, put them on the back burner. Find the ones that invest in your area, find the ones that invest early stage, seed, focus on those. There are over 1,200 venture capital firms in the US alone, 1,200. So there's lots of them. Europe's got, I think, a couple hundred. So you have to do another kind of homework when you're raising follow-on capital. The pitch, I'm going to get into that. We talked about the last 3 days, what the pitch is all about. I'm going to get into financial projections in a little bit. But assuming you get through with that first pitch, you're not done. It's very, very rare that one presentation will get you funding. It will almost always take a second and a third. And the way it usually works is the more junior members of the partnership team do the first meetings. They bring it to the attention of the larger senior partnership team, and if they vote to bring you in, you know you're much further along. So that second meeting is typically, if you're coming, with the senior partners of the firm. What goes on then, if the interest is there, a deep dive on your technology, on the competition, on the IP, on you. We look for criminal backgrounds. We look for people that have had bad credit history, because that's indicative of not managing money well. We look for a lot of things. And I'll talk more about that in a little bit. Typically, a lead investor, and it's typically an institutional, so one investor takes the lead and then they bring the co-investors to the party. If that's positive, now you're going to get to the next part of the process, which is negotiating on the value of your company, how much money to raise, how much that investor is going to get for that, and other terms that I'm going to talk about in a few minutes. And this process repeats itself typically several times if you're raising a Series A, which in the US is typically a $3 to $7 million round. So the larger the round, the more homework will be done, obviously. At seed level, you can typically get a yay or nay by the second meeting because it's less money being put to work. Here's the tools, excuse me, sorry, that we use. We bring our specialists in. We don't always have, as a firm, that knowledge, so we bring domain experts in. We go to industry analysts. One thing you do want to, if you're in that sector of enterprise, you want to get recognized by those analysts, Gartner and the like, because once you're recognized by them, they become part of your marketing engine. Not only helping you get customers, because you're now on their Gartner hype curves, if you would, or valuation, but we as investors look to that list to see who your competitors are and how Gartner evaluates them relative to you. There's several of those. There's 451 Group, there's Forrester Group, IDC, but Gartner's the principal one. We do reference calls if you have customers, clients. We visit the company, your company, because we want to know everybody on your team. We want to understand. Somebody asked the point about team dynamics. We want to watch that in action. Because if we see dysfunctional behavior, we see people not collaborating, you're going to see the likelihood of success of that company is not high. And due diligence, if there was a previous round, we get that information from the previous round, and we collect that and add that. And then basically, there's a gut instinct. That's the pattern recognition thing. We see thousands of startups. So we learn, we look for things that are likely to be success criteria, which I already talked about, as well as things that I'm going to talk about that are failure criteria. The hurdles you have, lack of a company history, you're a startup. Okay, so you have to overcome that. Lack of differentiation. This is the one I've talked about in the group so far, right? Do your homework. Make sure you know. 90% of presentations that I do take, everyone says, we're unique, we're different. We're in this upper right quadrant, and everybody else is down there. I go type 5 words in Google from their presentation, and I see 7 companies that weren't on their list. Your credibility's just been shot because you didn't do enough homework. So you have to really know your competitors and know how to articulate how you're different. Of course, as a startup, you don't have market history, so you have to convince people that what you're going to do is going to be game-changing enough to drive the market. Lack of a market itself. There may not be a market, big enough market for what you're looking to bring to the market. And don't hyperbolize. If you don't over-exaggerate. Be credible. If you make a statement, be able to back it up with facts and data. By the way, one thing I forgot in the first 3 groups, when you reference market size and the like, reference your source. Tiny print. You don't have to, just so everyone knows it's from a third party. It's not just you guessing, because that's not credible either. Find an online source through Google. Beauty is it's all out there, this information. Market size of whatever industry you're in, and you'll get lots of answers. And don't inflate projections. The typical hockey stick. No revenue, and I'm going to talk about what that curve really should look like. Changing economy. You can get caught 2000, 2001, the dot-com bomb. In 99 through 2001, the market was exploding, and in 2008, same thing happened. Some things out of your control. Okay. Terms of investment. When you get to the point where somebody's gone through their due diligence and they're ready to consider an investment, they're going to give you what's called a term sheet. It's not legally binding, but it's indicative. There's an indicated interest in making you an offer. And there'll be terms that I'll talk about here in a minute, but it's typically how much we're willing to value your company at, which means for X amount of GEL or dollars, how much equity we get. The higher that valuation number, I'll show you in the next slide, the less percentage equity we'll get for that amount. So I'll come back to that point because you need to see sort of the algebra behind that. Typically comes after a fair amount of due diligence, as I said, less in seed, much more in later stage. Okay, the valuation, the company's what's called pre-money. This means before new money's put into your company, you have a proposed value, and you want that number to be as high as possible. And we as investors say, no, we want it to be as low as possible. And where we converge is using metrics of other startups where it defines based on, and I'm going to talk about these also, what your company really should on average be worth. So the VC equity then is a result of that calculation. And again, I'll show you that detail on I think the next slide. Other important elements. One thing at this point, you definitely need to get legal advice. And hopefully Gita, through its network connections, there's several international firms here. I know DLA Piper's here. They're in Silicon Valley as a law firm. They're here. And there are several others that are here in Silicon Valley. The reason you want those kind of firms is because you not only need to have a law firm that knows your law, but if you're going to raise capital in Silicon Valley, U.S. law. So you can get that help upstairs from, I forget which accounting firm that's resident here. Sorry, Deloitte? But they are really accounting oriented. They're really not lawyers. So at some point you want someone that has experience with startup term sheets and agreements that go beyond what an accounting firm typically can help you with. And you get into all these issues. And I'm not going to go into these in too much detail, but remember this is very important to get knowledgeable on. You can go online and you can get examples of this. If I went into all this, we'd be here till 2 o'clock in the morning, so I don't want to do that to anybody. But things like board seats, the voting rights of you versus the board, something called drag-along and tag-along rights. This has to do with bringing minority investors along with the majority, the new investor that's putting the most money to work. Liquidation and dividend preferences all has to do with when the company does sell, how the money gets dispersed out to investors and to you as managers. There's typically an exclusive negotiation window. 45 days is typical, where that once that term sheet's handed, they don't want you out talking to a lot of other firms. So don't sign that term sheet until you're fairly confident that that firm is serious about investing in your company. Because, and I have to admit, there are many venture capital firms that do this just to get you off the market so they don't have competition. So use your legal advice again to help you think through that. Anti-dilution, again, if I went into any of these, I could spend 30 minutes on any one, but it has to do with if a later round is valued lower than the previous round of your company, what happens to the shares in the previous equity round? And it's an algebra and math to make it fair to them in the process. And then milestone expectations. This is very, very, very critical. I've been on both sides of this, so I can empathize, right? I've been the startup guy, and I've been the investor. Get clarity with your investor on what their definition of success is and yours. Let me give you an example of what that means and where the friction tends to happen. Remember, I have a fiduciary duty, a legal responsibility to my investors to maximize the amount of return I'm going to get for investing their capital in your companies. So I have to put them first in that negotiation. You, as the entrepreneur, need the capital to grow your business. But at the same time, you want to make sure that what success is at any point, so if you take in 1 million GEL, at the end of that 1 million spend, and that's why it's so important to get that on your slides, the 100,000 GEL for this, what are you delivering? Because Gita will want to know what they're getting for that $100,000. What have you done? And then for later rounds, the same thing. And you must get closure with your investors on that point. I've seen it where there was a misunderstanding. The VC thought this was going to happen, and the management team thought this was going to happen. Got to get that locked down. Okay, so this gets now to how do you value the company? How do you determine what your company is worth? When you have no revenue, if you're a large company with cash flow, it's what's called a discounted cash flow analysis. So it's the amount of profits distributed over time, discounted against time. So money gets less value because of inflation. So if you have 5% inflation, a gel today is worth 95 gel, or 100 gel today is worth 95 gel next year, 90 gel the next year. So the money becomes worth less. So it's called discounting. And again, I'm not going to go into all that detail, but there's a lot of information on the internet if you really want to get smart on that. But with startups, you don't have revenue, typically. You certainly don't have profit, typically. So a few of you do, and that puts you in a different category. But how do we then figure out what you're worth? So here's how it works. I have to believe that the money I invest, I'm going to get 10 times that back. 10 times that back. I know I won't in every case because there's so many unknowns in my risk management, but a successful fund will get at least 3 times its money back. So I have to believe before I'm going to invest that I will get 10 times because I know out of 10 companies, if I'm doing a Series A, 5 of those companies are going to fail. They're going to go away. They're not going to survive. 2 of those companies, I'm going to get my money back. 2 of them, I might get twice my money back. I make all my money on the 10th one. That makes 50 times what I invested. And when you average that all together, I'm typically going to make 3 times return on my invested capital, or if you're familiar with the term internal rate of return, about a 30% internal rate of return. So what does that mean? You're going to put a forecast together and say your revenue is going to go like this. When your company's going to exit, I have to believe that that revenue and that income will happen. Why? Because the value of your company, and I'll give you a typical software as service company, a cloud-based company. And I mentioned to several groups here, Pacific Crest benchmarks. This gives you information on how fast a company on average grows in the startup world, how much you need to spend on sales and marketing to get there, how much you need to spend on product development to get there. Look at that data, because in the end, if your numbers are out of line with that too much, I'm going to say your numbers aren't credible. And again, I'm going to show you more details when I get to the financial charts in a minute. But, okay, so that company at exit typically is going to be worth 4 times the revenue, or if it's profitable, 15 to 20 times the profit. And so now go out there 5 years from now when the company's going to sell. If I invested $1 million gel here, I have to know I'm going to get 10 million gel back there. So it's algebra at that point. The revenue or the income has to be a certain number that I believe will happen in order for me to get that 10x return. I know this concept is probably going past many of you right now, but when I show you the financial charts, hopefully it will help fill in some gaps. So, but this is very, very important because post-money, this is after you take the money in. So let's say your company is worth $1 million gel before the money comes in. If you take an investment of 100,000 gel, your company's now worth what? 1.1 million gel. Okay, do you follow that? Okay, I'm seeing a lot of struggling eyes. This is the value before money comes in. This is the investment. This is now the value of your company. Because guess what? The only thing that's changed is there's now 100,000 gallon more in the company than there was before you put the money in. So you got 1.1. Now, why is that important? Pay attention, because this is how much of your company you end up giving away to the investors. The VC equity is that calculation. I know, okay, it's algebra, but it's basically the investment divided by the post money. So take the example. The company was worth Let me make a simple example. If the company had a pre-money V of 1 million gal and an investment of 1 million gal, post-money is? No, I changed it. 2 million. Change the example. So, what is the equity in the company? 1 million divided by 2 million. Because 1 plus 1 and 1 million invested. I own 50% of the company. So you want this number, pre-money, to be as low as possible or as high as possible, and I want it to be as low as possible. So I have the greatest chance of making a return. And this is the stork dance that I talked about. Gita will be able to help you think through this, and hopefully will be helping you along the way as well as we move forward with the program. Yes.
But what about the shares? I mean, when we know.
Hold that thought. I'm going to come to that in a minute, if it's okay. I actually have math, and I'll show you what's called a capitalization table.
If I'm just raising the money 1 million with the 5%, in our case, we are raising the 100,000 gal, and we are
giving up 5% of the company.
It means that our valuation is 5 million, yes?
100,000 times 20.
To 2 million, sorry.
2 million.
2 million, yeah?
Exactly. And I'm going to show you an example in a minute that will help you look at that. So they're being very supportive because a typical startup isn't worth 2 million gal when it's at the stage you're at. They're being very supportive of you by only asking for 5%. I can tell you VCs in other parts of the world demand 50% of your business when they give you that first 100,000 gal. It is not doing that. They're being friendly. Question in the back.
This depends on the term sheet, which we haven't seen yet.
Sorry?
If this is a fair offer, it depends on the term sheet, which we haven't seen yet.
Correct. Exactly right. Okay, so let me go back to this example. 5 million invested, 10 million pre-money, 10 million plus 5, 15, 5. In this example, they own 33%. And I'm going to go into all those term sheet issues in a bit. Partners in a venture or outright purchase. The bottom line is sometimes an investor wants to own your company. They want to acquire it. So that's a different animal. VCs, typically, we don't take majority control. Do not. So we maintain minority interest in your company. And I and V in that equation are always terms of negotiation, but there are many others to the point in the back that I'm going to talk about in a minute. Generally, I've already said this, the company wants a large V and the investors want a small V. Sorry, I'm off the chart on this. Something happened on that one. And of course, that all impacts later rounds. Okay, so I just talked through this on the left side. The right side is the rounds. Oh, I know what happened. I left the earlier version of that slide in. The rounds V and the other terms and conditions to the point made in the back are important to understand those ramifications, and I'm going to talk about them in a minute. And other possible elements of valuation are the multiple of existing or projected revenue or earnings. That's typically projected because you don't have it yet. So we have to come to a common agreement on what's a reasonable projection and the projected percent of the market share. Okay, board seats. Once you become a company that takes investment capital, you now have a board of directors. Once you do that, you share ownership of the company with your investors. So they typically, not always, typically will take board seats and get representation on your board to make decisions like how you spend your money, They don't typically get into lower level details like who you hire for a sales position, but a good investor will offer to interview that person to make sure they're a good candidate for you. They're not involved typically in day-to-day operation. They only, a board in an early stage company typically meets anywhere from every 6 weeks to maybe once every 3 months. And then they go through, how's the business doing? How do we make it better? Strategic discussions. How do we improve the team? How do we raise new capital? Who do we go to do that? All of those kind of things. They hold extreme control, the board, in issues relative to when the company can be sold. Now, if you're still majority control, you have a very, very strong voice in that decision, but your board participates. Mergers, acquisitions, go in IPO. If you go bankrupt, it happens. And executive replacements. The lead VC typically in each round takes those seats. Voting rights fall into those areas. You'll do a budget once a year typically, and then in each of those board meetings, you'll be monitoring how you're doing against that budget that you propose. So it's very important to make that budget conservative enough that you're comfortable you can do it. And then strategic or business plan changes as you come along the way. Important to understand these nuances because board voting rights versus shareholder voting rights, again, this is where you need legal guidance, are different. You can have majority control of shares, but not necessarily majority control of your board. And the board has different rights than you and other shareholders have in decisions. Other typical VC rights, right of first refusal on the sale. So if somebody wants to sell shares, your VCs get the first right to buy those shares at the price being offered. Tag along, this is follow founder sale on a pro rata basis. So if you're the founders wanting to sell shares, pro rata means equal percentage. Again, I don't want to spend too much time in this because I think it will become overwhelming, but drag-along rights, where there's a forced sale of the company, liquidation preferences, participating versus non-participating rights, non-competes, anti-dilution that I talked about earlier. Again, I know this is you're probably going, whoa, but let me reiterate, this is where it's very important to get some support from either a legal firm or one of the international accounting firms that are resident here. And so on and so forth. Like I said, oops, sorry, I keep doing it. If I went through every one of these, we'll be here tonight. Okay. Why multiple rounds and VCs? This is a very interesting point, because on one side, you're saying, well, don't I always want to take as much money as I can, as early as I can, so that I have a lot of money and it lowers my risk? The answer is typically no. And let me tell you why. Because when your company's V, remember that pre-money calculation, it will be lower before you start doing things to generate revenue. You're going to be giving up more of your company for that same amount of money. So you only want to take enough money to get you to the point where you're comfortable you're going to be able to raise additional money. Now, some entrepreneurs will say, oh, I don't want to take that risk. I just as soon take as much as I can up front and give up more ownership of my company. That's a personal decision that you make. But recognize that's the trade-off that you get into. The multiple rounds, there's many points of valuation. The company's money gets cheaper, so you give up less for the same amount of money as you're progressing. So the faster you can grow your revenue or your customer base, the faster you can do that, the less you're going to have to give up when you want to raise more money. Understand that point? Very important point. VCs allow specialization in stage and strategy. So typically, the ones that are coming here next week tend to invest in very early stage or support, or IBM Ventures is going to be here, so they do supporting roles. Single round is typically wasteful of capital. I'll talk about what that means in a little bit. Multiple VCs, company amortization of control. This is we want to bring to share the risk other VCs in, because none of us have all the answers either. So we'd like to share the risk with other investors. We share our due diligence of the market and the team, and then sometimes both, different VC strategies. Some are financial, institutional investors, strategic. They invest because they want to have something that will help build their business. Okay, let me stop for a minute, because the next step I'm going to take is a video by a very famous guy that was the chief evangelist of Apple in the very early days, Guy Kawasaki. He's really a great guy. This is, he brings a perspective from a slightly different point of view. But I wanted you to hear that. And before I do, I wanted to stop and see if there are any high-level questions on those last slides. Now, afterwards, I'm going to go into much more detail on balance sheets and capitalization tables and show you examples of the financials. Question?
Hi. I have a question about exit when you have multiple rounds of investment. What's strategy of exit? I mean, who takes money first and how it's done?
Yeah, there was something I talked about earlier. It's called liquidation preference. An investor putting money in wants to know they're going to get their money back out first. So if they have a normal standard liquidation preference, if they invest 1 million gel, and the company ultimately sells for 3 million gel, they are guaranteed to get 1 million of that back before the rest of the investors that aren't cash investors participate. So that term I had earlier of participating versus non-participating gets into another level of nuanced detail. What that means is after they get that 1 million back, they don't get any more until they convert their shares to common, which makes them equal to you, and then the algebra changes. So again, very important to get someone providing you examples and guidance on this. And again, sorry, which accounting firms here? Deloitte. Folks upstairs. That's one of the reasons they're here, to help give you that kind of guidance. Okay, so this, yes, Dave.
Could you explain what you mean by amortization of control?
Yeah, it's spreading the risk. So it's amortizing, it's distributing. So in the first round, I may be the only investor. In the second round, I may bring 2 other investors in. So now we've spread the ownership between the 3 of us. And so it's basically spreading the risk and the ownership of the company because they're taking shares in the company. I'm going to show you what's called a capitalization table after this video, so you'll better understand what I mean by that. Any others? Yeah. Sorry.
If there's a good idea, which means to build prototype needs, it's cheap to make prototype. And
Yeah.
the idea is very good, but it needs investment for example, 2 millions. What happens then? How the shares are divided in this case?
Excuse me, again, let me show you in an example in a little bit exactly how it happens in all cases. Okay, you'll see the math after this video.
Okay, thank you.
Okay, I'm going to start this video, and I may not go through the whole thing depending on if you raise your hand and say, okay, that's enough, because this is a 30-minute video. But he's very energetic, and he brings up different nuances, but he's another example of what you'll see in Silicon Valley from an evangelist standpoint, because he was the guy that made the Apple brand. So watch him, listen to how he operates and things, because he's the guy in the early years that developed the Apple brand. Okay, ready? All right, here we go. It should start by itself. There we go.
Good morning. Good morning. My name is Guy Kawasaki, and this is my son Nate. And Nate happens to be traveling with me on this trip. And when we were backstage, he said, "Can I go on stage with you to see what it's like?" And I didn't want to stifle his creativity and stifle his daringness. So here he is. So now take your selfie. Okay, beat it. So my name is Guy Kawasaki. I am the chief evangelist of a company in Sydney called Canva. I'm here today to talk to you about the art of starting things, specifically the second version of the art of starting things. I come from Silicon Valley. I was the chief evangelist of Apple. I was a software evangelist for Apple. I was a Motorola advisor. And I am currently not only the chief evangelist of Canva, I'm also on the board of trustees of the Wikimedia Foundation, which is the Wikipedia entity, and a visiting executive fellow at the School of Business of UC Berkeley, Haas School of Business. And I have to tell you, I just love your country. I come to your country 2 or 3 times a year, and I'm gradually getting more and more assimilated. I only drink flat whites now. I love this Japanese restaurant in Surrey Hill called Taco. Fantastic place. When I die, I have decided that some of my ashes will be spread in front of Bathers Pavilion at Balmoral Beach, because I've actually written books in Bathers Pavilion, and it's just, I don't know why, it just brings me great peace to be at Bathers Pavilion. And to show pictorial proof of my assimilation into the Australian culture, I present you with this picture. So I've been drafted into the Bondi Bathers Club, and I'm going to go through my life-saving thing. A few days ago, my family and I went swimming in icebergs, the saltwater pool. And let me tell you, there is a reason why that thing is called icebergs right now. It is absolutely freezing cold. So I've had a great time. And now I'm going to try to pay my host back by providing information about startups. Nolan Bushnell, who came out 2 speakers before, is a fantastic example of Silicon Valley entrepreneurship, innovation, daring, and all the good stuff. So he was one of my heroes. And I hope to pass on 10 good tips about entrepreneurship for you. So let's get started. So the first thing that I learned about entrepreneurship is that great companies, great entities start with people asking very simple questions. You know, when you look at a Microsoft or an Apple or a Google, you might think at the very start of that company, they had a grand vision of how they would have operating system and application and devices and gaming and online presence. And I think you'd be very surprised to learn that most of these great companies started with something very simple. Questions like, therefore what? This happens when you have a perspective, a vision, a passion, and you know in your heart that someday there'll be lots of phones, and these phones will have good cameras, and these phones with good cameras will all be connected to the cloud. Therefore what? Therefore you start Flickr or you start Snapchat, because when this vision comes true, there'll be so many ways to get pictures online. There should be a service to tap into that phenomenon. So you start a Flickr. The second concept is, isn't this interesting? This happens when geeks and nerds get together and they try to create something and they fail. Luckily, they fail. And when they fail, they notice something that's interesting about their failure. An example that goes back decades from America is, of course, Post-it pads from 3M. 3M is in the business of making chemicals. They specifically wanted to make a very strong glue. They completely failed, and they made a very weak glue. A glue so weak that you could attach it to a piece of paper, stick the paper on something, and pull the paper off. It would leave no trace. Very, very weak glue. But isn't this interesting? And Post-its was born. The third question is the genesis of Apple. You know, is there a better way? Why is it that to use a computer, you had to go to a university, you had to work for a large company, you had to work for the government? Is there a better way? And there came the Apple I. 3 examples of the kind of simple questions that entrepreneurs ask themselves. So what I'm trying to tell you is, don't put this burden upon yourself that you have to come up with this megalomaniac plan to create this multi-billion-dollar corporation that's going to eventually control the world. Ask and answer simple questions. Step 1. Step 2 is to make what I call an MVVP. Most people are familiar with the concept of an MVP, minimum viable product. I would like to add to the list of V's, not just viable meaning you can sell it for more than it costs to make, but also valuable, that you've created a product that, to use the words of Steve Jobs, dents the universe. It makes a difference. Because you can have something viable that is not valuable. You can make money doing things that are mediocre and mundane. And the final V I'd like you to add is validating. That this product, this service validates your vision, validates your perspective, your idea, your hope for the world. Let me use a negative example. Let's suppose that one day you open up your browser, you open up your newspaper, you find out that Apple is going back into the printer business. It's going to start selling laser printers again. Let's apply the viable, valuable, validating test to that laser printer. Is it viable? Absolutely. People will buy an Apple-labeled laser printer. No problem, right? So they'll make money doing it. Is it valuable? I would debate that it's not valuable. What difference does it make to the world if Apple sells a leather laser printer? And does it validate anything about Apple's vision for the future? Not at all. So a laser printer from Apple is viable, but it is not valuable, and it is not validating. Entrepreneurs in this audience, as you come up with your product ideas, I want you to rise above minimum viable product. I want you to make a minimum viable, valuable, validating product, the MVVP. Number 3 is to get going, to get started. So many entrepreneurs or would-be entrepreneurs are just obsessed with shipping something that's perfect, and they take too long. My experience is that people ship things too late more often than they ship things too early. If you're going to make a mistake by shipping too early, not too late. The key to doing something like this, to getting off to this fast start, is to do something that is probably cringeworthy. You're going to look back and you're going to say, my God, how did we ever think we should ship what we shipped? It should embarrass you. The first book that I wrote, when I look at it now, it embarrasses me. When I think about the first Macintosh that I was affiliated with, 128K of RAM, 400K floppy drive, the secret hard disk that was a whopping 5 megabytes. Thanks to my efforts, there was no software. My God, what were we thinking? It makes me cringe to think about the first Macintosh. But you know what? If you're in an organization and you have the luxury of cringing about your version 1, it means you probably did it right. And by definition, if you're in an organization and you're thinking about version 1 that makes you cringe, at least it means you are still alive. Don't worry, ship something cringeworthy. Next thing is to find complementary soulmates. 2 key concepts in this bullet item. First, complementary. Complementary means that fundamentally, in an entrepreneurial organization, there are only really 2 necessary skills. Somebody has to make it and somebody has to sell it. Everything else is bullshit. Make it and sell it. And so if you're an engineer, you need to find someone who can sell it. And if you're a salesperson, you need to find someone who can make it. If you're all engineers, there will be no one to sell it. If you're all salespeople, there'll be nothing to sell. Steve Jobs needed Steve Wozniak. Steve Wozniak needed Steve Jobs. Complementary. And soulmates. Soulmates mean that you need to be on the same page. That if some of the founders are looking at a company as a lifestyle company where they'll work part-time and they'll never come in on weekends, they'll never work late, they're trying to build a company that suits their lifestyle and maybe they'll quickly flip it, and other people are willing to dedicate their lives. They're going to lash themselves to the company. If the company goes down, they're going to go down with it. That's not soulmates. You need people who are on the same page. Third point about getting started is to make a mantra. I think many organizations, particularly American ones filled with MBAs, spend much too much time making mission statements. The purpose of these mission statements is to kind of cover every possible group that's involved, every party, everything. So mission statements come across like this, where we endeavor to create patent-pending, curve-jumping, paradigm-shifting products that exceed the expectations of our customers while enabling our shareholders to receive a monetary, reasonable return, while enabling our employees to self-actualize their life goals while killing as few dolphins as possible. Okay? That's your American mission statement. What you want is a mantra. A mantra has only 2 or 3 words. The mantra for Google: democratize information. Apple: increase productivity and creativity. Federal Express: peace of mind. It's stuff like that. My personal mantra: empower people. 2 words that define why I exist. Make a mantra. The next thing you need to do is to define a business model. Absolutely necessary, perhaps distasteful to some people, but you have to make money. Some key concepts about a business model. First of all, be specific. It's not about saying, well, we're a software company. That's not specific enough. Neither is saying we're an enterprise software company. That's still not specific enough. You need to say you are an enterprise software company serving the biotech industry, specifically the application for FDA approval. It should be so specific that you have the name or the title of the person who has your money in her pocket. Your job is to get your money out of her pocket into your pocket. That's the definition of a business model. It is that specific. Next point is to keep it simple. You know what? There are many ways to innovate on products and services. Very difficult, very rewarding if you pull it off. I would suggest that if you can pull off the engineering, the science of innovating with a product or service, you should not also open up a new front called we're going to innovate on our business model. It's too hard to innovate on product and service, and then to throw on you're going to innovate on a business model. You're making your life too hard. Basically, you want a business model where it costs you $1 and you sell it for $10. That's it. Very simple. Third point is to ask women. The reason why I tell you this is because I believe that men have a fundamental genetic flaw. The fundamental genetic flaw is men want to kill things. Men want to kill plants. They want to kill animals. They want to kill people. They want to kill countries. They want to kill political parties. They want to kill products. They want to kill services. They want to kill companies. Okay? So whenever you ask a man, is it a good idea to start a YouTube killer? Is it a good idea to start something that will kill PowerPoint? Or Apple, or Apple's watch, or Apple's MacBook? Is it a good idea to start a bank to kill Commonwealth Bank? Every man always says yes. Because men cannot resist the temptation to try to kill things. Women do not have this fundamental genetic flaw. So when you want to know if you have a good idea and you have a good business model, do not waste time asking men. Only ask women. Number five is to weave a mat. You know, when you start a company, it is a beautiful situation. It's like being the first skier down the mountain in the morning. If you're into figure skating or ice hockey, it's like being the first person on the ice after the Zamboni has shaved the ice. It's just a beautiful feeling. And a company, when you start it, is just like that. You know, if you're in an existing company, you have these crappy employees you never should have hired. You have this crappy furniture and this crappy office. You have a crappy architecture. You have this crappy install base that's bugging you for free upgrades. You got all this stuff, right? But no, when you start a company, it's pure, packed powder that no one has skied on. And in that kind of scenario, you're tempted to think, well, there's so much stuff we can do in our new company. We could like work with graphic designers and design a new logo, this really cool logo. And we could create these viral Kickstarter 90-second videos, you know, that's going to win awards. And then we can order stationery, and we can go to whatever your version of IKEA is, and we can like build this really cool stand-up desk with an electric motor connected to it, and all this kind of cool stuff. Because when you're on a sheet of ice or at the top of the mountain that no one has skied down before, it looks all so interesting. So a mat is to help you prioritize. The first thing you should do is worry about milestones. Milestones are things that you would call up your spouse or text your spouse and say, honey, today we shipped. Today we finished the design. Today we closed our first sale. You would not call up your spouse and say, honey, today we ordered business cards. Am I not a great entrepreneur? Next thing is you have to test the assumptions of your business. This is very important. You know, I'll give you the Silicon Valley pitch for Pets.com. 300 million Americans, 1 in 4 owns a dog. That means 75 million dogs. Each dog eats 2 cans of dog food per day. 150 million cans of dog food per day. How hard could it be with our rock star programmers to make a website with e-commerce using black hat SEO techniques to get a mere 1% of that 150 million cans per day? That's 1.5 million cans per day. 365 days a year. Because this is B2C. Actually, it's B2D. This is not B2B, right? Dogs eat every day of the year. So you test this assumption that, it's not so hard to get 1.5 million cans of dog food per day. Well, one way of testing the assumption is to do a bottom-up analysis. The way the bottom-up analysis works is, using all our SEO, black hat magic and all this kind of stuff, perhaps we could get 100,000 uniques to our site in the first few months. Let's say of those 100,000 uniques, 1,000 buy a case of dog food. So 1,000 people buy a case of 25 cans of dog food. That's 25,000 cans of dog food. So we have a little bit of a discrepancy. Bottom up, we come up with 25,000 cans of dog food per month. Going the other way, we come up with 45 million cans of dog food per month, conservatively speaking. And I hate to break it to you, guess which side of this spectrum your results are likely to be? 25,000 per day, 25,000 per month. So you need to test your assumptions. Next thing you do is to actually ship, to launch. To not simply talk about this 1%, this growing market, but you need to get it out there. And finally, you do tasks. Tasks are things that help you reach milestones, test assumptions. Stuff like hire an engineer. That's a task. Ordering a logo is not a meaningful task. Milestone, assumption, test, task. The pecking order of entrepreneurship. Number 6 is to tell your story. Great entrepreneurs can tell their story. You know, many entrepreneurs stand up in front of an audience and they say, I have patent pending, curve jumping, paradigm shifting, enterprise, scalable product. Everybody says that because they think that everybody else stands up and says, I have a piece of crap that's slow, buggy, and hard to use and cannot scale. So this is the opposite test. The opposite test means that ask yourself, is your competition saying the opposite of you? Is your competition saying, I have a slow, buggy, hard-to-use piece of crap? So now you come up and you say, I have patent-pending, curve-jumping, paradigm-shifting, bug-free, really fast, easy-to-use product. The odds are that you're flunking the opposite test. If everybody says the same thing, I don't care what adjective you use, you're not saying anything different. The second point is to make it personal. You know, the great stories of Silicon Valley are not about penetrating these large growing markets. Pierre Omidyar, the founder of eBay, tells a story that the reason why he created eBay was because his wife was a toy collector. She wanted to sell her collection of Pez dispensers. There was no way for her to do it. So he created eBay to help her sell Pez dispensers online. Incidentally, total bullshit story, okay? But it is a great story nonetheless. Great story nonetheless. The point is to make it personal. And the third point is to embrace what I call the 10-20-30 rule of PowerPoint or Keynote, depending on what app you use. This means that you have to tell your story with 10 slides in 20 minutes using no font larger than 30 points. If you just did that, you'd be better than 90% of the pitches in the world. 10 slides, 20 minutes. Why 20 minutes when there's probably a 60-minute window for your appointment? It's because despite my efforts, to this day, roughly 90% of the world uses Windows. And I know that if you carry a Windows laptop into a meeting, it takes 40 minutes to make it work with the projector. If the whole world used Macintoshes, this would be the 10-60-30 rule, okay? And 30 points. Select all the fonts in your presentation, make them 30 points, and see how much goes off the page, and keep cutting till it all fits. 10, 20, 30. Number 7 is to hire infected people. By infected people, I mean that you need to ignore irrelevancy. Okay? Everybody knows when you hire somebody, you look at their education and you look at their work experience. You're looking for a match. You're looking for relevancy. You're looking for proven potential, all this kind of good stuff. And I'll tell you there are 2 cases. One is, let's say you're trying to hire somebody. Perfect educational background, perfect work experience, but does not love the product, does not get it. In that case, I would make the case that the perfect education and perfect work experience is irrelevant. Ignore that. Don't hire that person. The flip side is also true. Let's say the person doesn't have the perfect background, education, and work experience, but does love the product, thinks that the product is world-changing, denting the universe. When I first saw Macintosh, I swear, the clouds parted. The angels started to sing. Okay? You need to ignore the irrelevant. I came to Apple from a background of working in the jewelry business, literally schlepping gold and diamonds, counting gold and diamonds. No computer science degree, no work experience in the computer science business, in the technology business. Ignore the irrelevant. Second thing is to hire better than yourself. A players hire A+ players. B players hire C players. C players hire D players. E players hire F players. And so we go. If you start hiring B players, if you lower your standards, you're going to be surrounded by Z players. This is called the bozo explosion. You need to fight the bozo explosion. Last point on hiring infected people is to apply the shopping center tests. The way the shopping center test works is this. Let's suppose you go to a shopping center. You go to Queen Victoria building. And you look across the way and you see someone that you know is interviewing at your company. Okay? So you can make a beeline straight to that person and say, I know you're interviewing at a company. I hope you join us. We're just going to kick butt. We're going to change the world. We're going to democratize design at Canva. Whatever it is, right? One reaction is you just make a beeline to that person. Second reaction is, you know, Queen Victoria building is not that big. If I get face to face with that person, I'll say hello. Third reaction is, I am going to go to Westfield Mall. If your first reaction is not to make a beeline straight to that person, I suggest you not hire the person, because startups are families. Dysfunctional families, but families. You have to want to go straight and see that person. Number 8 is to socialize, and I don't mean in the political sense. Socialize means that social media is the best thing that ever happened to entrepreneurs, because now marketing is fast and free and ubiquitous. When I started companies, we'd have to spend $75,000 for a Wall Street Journal ad. We'd have to go to Comdex and CES. Not true anymore. Step 1 is to perfect your profiles. The avatar, your face, should project that you are competent, that you are trustworthy, and you are likable. The cover story should tell the story of your company, your brand, or your career. But the avatar is just your face. The cover photo tells your story. Next point is you need to embrace the NPR model. NPR, National Public Radio, is like ABC for you. ABC, I think your government pays. NPR is supported very little by the U.S. government. They have to run these fundraising pledge drives every once in a while. But you know what? NPR provides such great content that people don't mind the pledge drive. In fact, we contribute. So the test for social media is you're providing such value that you can run a pledge drive. At Canva, we try to present such great content about design, not about Canva, about fonts and colors and photography,
that when we want to run our pledge drive, i.e. telling you about a new product or service from Canva, we have earned the right. And you feel the need to reciprocate, to pay attention to our pledge drive because we have been providing great content all year. That's the NPR model. Next thing is to pass the reshare test. The reshare test means that whatever you post is so great that not only do your followers like it, they will reshare it to their followers. It is a higher test for content. Because when people reshare your content, it means that they are risking their reputation on what you shared. And if you can pass the reshare test, you will increase the size and potency of your social media platform because more people will find out about you. Pass the reshare test. Number 9 is to seed the clouds. That is to make it rain. American colloquialisms for sales. The key to sales is to let 100 flowers blossom. You may think you know exactly what people should do with your product or service. Come to find out you were wrong. Unintended customers use your product in unintended ways. Don't freak out. Celebrate. Declare victory. Apple wanted to make Macintosh a spreadsheet database and word processing machine. Guess what? 0 for 3. Macintosh became a desktop publishing machine. We did not plan that. Aldous PageMaker was a gift from God that created desktop publishing and saved Apple. Imagine a world without Apple. We'd all have phones where the battery lasted for more than half a day. We'd have GPS. We'd have GPS that actually worked. We'd have a real keypad. We had phones you could put in your jeans and they wouldn't bend. It would be a different world. Let 100 flowers blossom. You think you have a spreadsheet database and word processing machine? Come to find out you have a desktop publishing. Hallelujah. Declare victory. Throw stuff against the wall. See where it sticks. Go up to the wall. Paint the bullseye around it. You hit the bullseye. God bless you. Number 2. Number 2 is to enable test drives. What you're saying is to people, I think you're smart. And because I think you're smart, I'm going to enable you to test drive the product and service, then you decide. Don't ram it down their throat. Third point is to find the influencers. You know, it used to be easy, top down. You sucked up to the Wall Street Journal, they made you. It's not true anymore. I'm not saying you should ignore the Wall Street Journal, but I'm telling you right now, the pyramid has become inverted. And now, Lonely Boy 15 at AOL.com, who lives with his mother and sleeps on Buzz Lightyear sheets, could make you successful. You cannot ignore that anymore. Social media. You know, in the business of books, it used to be that people waited for the New York Times book review to review a book before you bought it. If the New York Times blessed you, you had a bestseller. It's not true anymore. When a book ships on Amazon, in the next couple days, there'll be dozens of reviews. There'll be a conglomerate, cumulative score of 4 stars, 4.5 stars, or 2 stars. People go to Amazon, they look at 4.5 stars, they read a few reviews by Lonely Boy 15, not the Washington Post, not the New York Times, not the Sydney Morning Herald, none of that. They look at that, they look at the scores, and they click, and it's in their basket. That's the nature of marketing today. Lonely Boy 15 is the influencer. Number 10, don't let the clowns grind you down. Arguably the most important thing, and I'm 2 minutes and 48 seconds over time, but what can you do? Because, right, yeah, you're trying to cut me off, but I know that the next thing is a break. Okay, so what are you going to do? Not take me to Melbourne? So number 10. I spent 2 minutes introducing my son. What can I say? So, don't let the clowns grind you down. This is about bozosity. This is about clueless, stupid, negative people. There are 2 kinds of clowns or bozos in the world. One kind is a loser, slovenly, disgusting, pocket protector, Japanese watch, rusty car. That's a loser. That's not dangerous because only a loser would listen to a loser. So unless you're a stupid loser, you don't have to be afraid of other stupid losers because you're not stupid enough to listen to the loser. No danger. The dangerous bozo, the dangerous clown, is a successful bozo or clown. Dresses in all black. Owns lots of stuff that ends in I like Armani, Ferrari, Lamborghini, Maserati. Audi is okay. Audi is the exception. Okay? So you look at that person and you think, wow, rich, famous, must parse to smart. I should listen to this person. I would tell you rich and famous parses to lucky half the time, right? And now you know that Tom Cruise doesn't have a perfect symmetrical face. I still hope that you don't take his advice on religion, okay? He's rich and famous. I don't think you should listen to Kim Kardashian about raising children, okay? Rich and famous doesn't parse to right or smart. So I think that Bozosity is like the flu. How do you fight the flu? You get a flu shot. You inoculate yourself. So when you encounter big flu, you've built up resistance. I'm going to give you some Bozosity now. So when you encounter Bozosity as you start a company, you can resist the Bozosity. I think there's a world market for maybe 5 computers. Thomas Watson, chairman of IBM. 5 computers. I have 5 Macs in my house. I have all the computers he anticipated in the world in my house. This telephone has too many shortcomings to be seriously considered as a means of communication. The device is inherently of no value to us. Western Union, 1876. Oops! You know, Western Union could be PayPal today, could be Bitcoin, it could be Square, but not if you write off telephony. What were they going to do? Teach all the Americans Morse code and put a telegraph in every house? String a long wire behind your car, put a telegraph in your car? Hallelujah. There is no reason why anyone would want a computer in their home. Ken Olsen, founder of DET, great entrepreneur, great innovator, so successful in the mini computer curve, took us away from the mainframe curve. But he could not embrace the personal computer curve. Imagine if you were Steve or Woz and you met Ken Olsen and you told him your plans for personal computer, and Ken Olsen shut you down by saying there's no reason why anyone would want a computer in their home. Because if you think about it, at the time you were starting Apple, who would be a better investor, advisor, director, mentor than someone like Ken Olsen, right? And he would have told you, no one's going to buy a computer. There's no reason to have a computer in your home. This is dangerous Bozosity. Don't let the clowns grind you down. And that is the art of innovation. Thank you very much. Thank you.
Can we bring the lights back up? So a different point of view, but very important points. You know, Guy's been, as I said, you know, he's the one that brought 2 things about Apple that made it famous. Apple actually didn't invent anything. If you remember when the iPod first came out, there were dozens of e-music readers digitally, and they had tiny, tiny screens that I couldn't read. I couldn't even get my finger and push the buttons on, and I had a drawer full of them. And then the iPod came out and changed everything. Intuitive, easy to use. Keep that in mind. And then the brand messaging that Guy brings to the table is absolutely huge. You have to get yourself recognized from a brand. Make your products as usable, easy to use, because that in and of itself is discriminating. Apple never invented anything. Microsoft never invented anything. They made it better. They marketed it better. So your product, when I talked earlier about it's great to discriminate, disrupt, but there are other attributes, ways to discriminate and disrupt. And it can be marketing, it can be branding. So keep that in mind. Okay, we're going to take a break in 15 minutes, but I want to start the discussion on financial statements. And we'll take a break, and please come back on time, because I want to make sure you all get, I know there's a lot of questions that were asked earlier that I delayed, because this is very important. No, stay for now. I'm going to start the process, and then we'll take a break at 11, because I'm not sure they're ready for you out there yet. Okay, so what is financial statements? There are 3 parts to financial statements. Why is this important? If you're an engineer or marketing person, it's like, boy, is that painful to even think about. But it's critical, because if you don't understand a simple principle of your checking book, the amount of cash that comes in versus the amount of cash goes out. If the amount of cash that goes out is greater than the amount of cash that goes in, you're broke. And you have to know when you'll be broke. So how that money gets spent in the process is very, very important. And I'm also going to talk about the questions earlier about how do we share the equity ownership, and that's going to be part of the cap table question that we'll get to in a minute. Okay, so 3 parts. Why is this important for your success? The bottom line is it goes like this. You have 3% of startups get funding, 3%. Very small number, that's 3 out of 100. Keep that in mind. All sophisticated investors beyond your friends and family, institutionals will require that. The forces, founders too, this really drives you to think about what the issues are to make your company financially successful. Because if you don't have that, your company, you may have a great idea, but you'll run out of time to get it to the market. You'll run out of money. It's a great benchmark. I talked about this and I mentioned this in a couple groups. That gives you, out of 200 startup and later stage companies in the SaaS business, it'll give you clarity around, on average, what it takes for product development cost, for sales and marketing, for other costs. On average, how fast will you grow? Dave talked the other day about customer acquisition costs relative to long-term value. That all ties in to what I'm going to talk about. And all of this material, if you go to that site, you'll find all that average. Now, why is that important? Because as an investor, if we see you give us a hockey stick and it's not credible, we look at this data and say, well, here's what averages say. You may be different than averages. You probably will be. But statistically, that gives us a way to compare you to what the average company is likely to do. And as Guy said, the bottoms up is almost always, estimates is almost always what happens. The top down 1% of a $1 trillion market never happens. Do it bottoms up. Think through how you're going to get to the capital. Our general rule of thumb is we take the revenue curve of the startups, divide it by 3. That's close to what will actually happen. But if you come with a realistic conservative plan, our confidence in you is going to go way up. Second is more information on how to go about this. So there's a huge amount of data on the internet. There's YouTube videos. There's educate yourself on these points. Okay, so let me get to the core of it. Software services is what SaaS is. So that means a cloud-based. Just using this as an example because not all of you are that. But the key points that are on this chart, and I apologize, tiny print, but in order to get an income statement, you have to get to this level on the slide. So right off the bat, there was confusion about what the term gross margin means. What gross margin means is revenue minus cost of goods. Revenue minus cost of goods. If it's gross margin percent, it's gross margin divided by revenue. Okay, so in that example, you see revenue. See if I can get the pointer. I don't think it'll work very well on here. Yeah, I'm sorry. Did I say? Yeah, that's correct. Divided by revenue, because it's a percentage of revenue. Sorry, did I say that wrong? Oops. Excuse me. So here's your revenue number. Here's your cost of goods, and I'm going to talk about cost of goods in a second. The difference between that number and that number is that number. Gross margin percentage is this number divided by that number. Follow that? Sorry if I said that wrong. Now, what's in cost of goods? And a lot of startups get this mixed up with product development costs and what are called operating expenses. This is not operating expenses. Operating expenses I'm going to talk about in a minute. Sorry. Sorry. In a software business like this, you basically have a few things. You have transaction fees, so if you're on an Apple web store, 30% of your income goes to Apple or Google. So right off the bat, you have third-party fees that you have to pay. And it may be other things like hosting expenses to host your app on the internet. Customer support, this is a very important one. That guy made the comment, get the product out fast, but when you do, be prepared to support it, because there will be bugs, there will be issues, and you have to, and early on, your engineering team has to be the customer support. When you get large like Oracle, we had 25,000 people dedicated to doing customer support. When you're a startup, your engineers are coding, and they're waiting for that phone to call to deal with issues that customers will have. And so that ties to internal engineering support, which is different than product development. And again, your Deloitte's and the like will help you with that. Then other professional services that may come into play. Second part of this, now this gets to the core of being realistic. Let me start from the bottom up. G&A is things like office space, computers, human resource support, accounting, that type of thing. That should be and always must be a relatively small percentage of your revenue. Where do you spend, as Guy said, the vast majority of your invested capital? Two things. Early on, product development. That Pacific Crest data will show you in the first year, on average, you're spending a significant portion of your funds for product development if your product's not done. But you have to rapidly get to where sales and marketing is at least 50% of your revenue or your funding that you have. Why? Because if you're not selling and marketing your product here in this month, you're not going to generate that revenue in that month. And the typical time delay, because you have to sell and market before the revenue comes in, is 6 months. So if you're spending this much here for sales and marketing, 6 months later, you will generate a certain amount of sales. And if you are an attractive offering that the market really wants, that relationship should be about 4 to 5 to 1. So if you spend 50,000 gal in, or let me do it, 5,000 gal in a month, 6 months later, you should generate what? 4 to 5 times that in revenue. A lot of startups start with, well, let me do, as Guy said, let me do it top down. I'm going to get 1.2% of the market. And they go right here and figure out, okay, I'll just kind of win. The fact is that doesn't happen. You must go bottoms up. You must say, how much can I afford to spend for sales and marketing? And once I spend that, 6 months later, what will that mean in revenue? Typically, that relationship is 4 to 5 because as you get to a steady state condition, you will be spending somewhere around 25 to 35% of your revenue for sales and marketing. So that relationship has to hold up. Or the other way to look at this, customer acquisition cost can't be more than 20, 25% of your long-term value from your customer, because if it is, you don't have a viable business and you'll never get cash flow positive. Questions? Well, one other point, product development. Obviously, you have to do enough. As Guy said, minimum viable product, but where you're only taking it far enough. Oracle, to this day, the largest enterprise company in the world, ships products, I don't think they want to admit it, but which ships products sooner than the development team would want them to ship it, because there are still bugs in the software. And no amount of what's called regression testing will figure out all the possible conditions under which the software might be buggy. So you have to get customer feedback. But they have a huge customer support organization that knows that and works with the customers to keep them happy. So customer support's up here. That's separate and distinct from building the core product. Questions? Yes. Hang on. Hold on.
What do you mean under sales, or what expenses are included exactly?
Sorry?
What expenses are included in sales exactly?
Let me give you an example of an Oracle sale of an Oracle product. It could be one of 3 things. It could be a direct salesperson. If it's a very large sale, they will go out, hired salesperson, to the customer, meet with them, show them the value of the product, negotiate the contract value, and then sign the contract and start generating revenue 6 months out. It's one type of it.
So wages, wages mainly.
Sorry?
Salaries. Mainly it's salaries, right?
Mainly salaries, yeah. Marketing, and by the way, salaries break into 2 parts. That salesperson in Silicon Valley, or in the U.S. in general, in the world, will require a base salary. In the U.S., it's about $125,000 to $150,000. Sounds very high here, but it's their base salary. But they will make another $150,000, the same amount, if they hit their sales target goal of selling $2 million worth of sales. So there it costs $300,000 to generate $2 million of sales. Pretty good, right?
Salaries and bonuses. Bonuses and salaries.
Yes, that's largely salaries and what's called sales comp, right? And then travel for them to go, because they have to go travel. And then marketing is the branding stuff. It's the stuff Guy Kawasaki does. It's the SEO stuff to the website. It's the Google ads. That kind of gets mixed between these two if it's that kind of a product. Other questions? Hang on.
Nicholas, so these slides are not in presentation. Can we, will be able to see this?
You will get all these slides.
Awesome.
We're going to make them available to everyone, all the presentations.
Yes, thank
Another question?
Yeah, I have here.
Sorry?
Yeah.
Oh.
We are building the software, so we will need some kind of salespersons who will just go to the companies and take some kind of information for the registration of the users, which means that this is the direct cost of goods, yes?
Yes.
Directly, and in our case,
here,
it must be placed there, yes?
Right.
In the
These
cost
types of things right here.
Yeah. Okay. Okay. Thank you.
Okay. By the way, let me come back to the sales only being salaries. If you're in a business where you're using Google Ads, you have to pay for those Google Ads, right? So that you can either put in marketing and sales, but it's in that combination. There's another kind of sales other than that person going out. It's what's called, Oracle has it, inside sales. Or you can hire a company that will be a customer call center that does outbound, reaching out to potential customers on your behalf, because it's something that is simple enough for them to be able to sell in a very repetitive way. If it's a sophisticated Oracle enterprise software product, you have to actually have people go do that on site because A, you can afford to because it's a huge sale, but B, it's a much more complex sale. Some other questions?
In connection to the question you just had, also if he has to send somebody to the company who wants to sell over his platform, and because the company needs some support for registering on the platform, isn't it more sales related than cost of goods? Because this task of registering the company does not have to be done later while they use the product.
When you say register company, do you mean a customer registering themselves?
No, in his case, it's a little bit complex. You can't just let the supply. He's going to operate a marketplace for construction material, yes? And you can't just let the companies register themselves because it's more complex. You need information about, to classify the type of business and the type of goods and so on.
Right.
But it's just the onboarding of the supply side on the platform, and later when they use it, and revenue will be generated, these costs are not going to occur again. So is it really cost of goods or cost of...
Think the differentiation by general accounting principles allow you some gray interpretation in that, but think of it this way. Use the words customer acquisition cost. Was it a customer acquisition cost? If it was, it goes in operating expenses. And there's grayness in the answer to that question, right? So.
Yeah, sure. I just wanted to make this clear.
Yeah, okay. Back in the back with this, Mike.
So you said that it takes a long time when you spend money on marketing and sales.
Yes.
It will generate revenue about 6 months later. And how does it vary about types of products for B2C or B2B products? Because, for example, for Oracle, it takes a long time because it's a hard product and you have to learn how to use it and so on.
Yeah, it's
so
very...
What about B2C and...
Thank you. It's very different, and I was going to get to that point. Thank you for jumping in on that. So B2B or enterprise sales is the model I was describing a minute ago. B2C, an eBay sale, maybe is a good example, right? eBay doesn't send out salespeople, although it's doing some of that now because it has some new offerings where it's trying to broaden its horizon. But in general, it's the website that's doing the sale. And that sale, in theory, from the time the person goes to the website till they buy, is minutes to hours. But when you aggregate all this, and when you look at that Pacific Crest data, you'll see what I mean by this. When you aggregate, there's still a time to build brand visibility and brand recognition that has to happen before that revenue occurs, even in B2C. Okay? Other questions? Mike.
In SaaS model, for example, do you include legal and financial advisory on cost of goods or operating?
G&A.
G&A.
That's the accounting, human resource
Legal.
support, insurance, office space.
It's all G&A or?
G&A.
Okay.
G&A. Anything that falls into not specific to delivering the product. Not specific to delivering the product goes in operating expenses. If it's something that all need, but it's not specific to that sale, goes in operating expense. There was another question.
Hi, we were wondering what would go into the cost of goods sold for mobile application for social network. So
Pretty
it's-
much
it's,
same thing
everything
that's
what's on the slides. Right,
Yeah,
over here.
exactly. Same thing that's on there. So you have to host that application, right? A mobile app has to be hosted somewhere. In there, Apple's taking that 30%, Google's taking its percentage, that's up there. Because that's like they're hosting it for you, right? They are, by definition, right? So it's in what you would call third party or hosting. Okay? Follow? Sure? Okay. Other questions? Two more and then we got to take a break.
When we asked what is our CAC,
Yes.
can the answer be that we are going to spend 30% of income on acquisition costs of customer?
Now look at it in
30%
terms of
revenues we're going to spend on customer acquisition. For
Yeah, you have to start with, forget about percentage of revenue when you talk customer acquisition costs. Think of it in terms of absolute cost. So if it's a Google AdWord, and you have an advertisement and you're paying so much for those Google AdWords, and it generates 5 sales for whatever you paid or per transaction or whatever, that's the absolute value that you would pay for that. In the end, we're going to look that should asymptotically approach where your cost of sales and marketing should be about, as I said earlier, 25 to 35% of your revenue. But you have to start bottoms up with that calculation.
So, for example, if I spend $10,000 for advertising,
Yes.
and I get 10 customers, I have to divide 10,000 per 10, and this is the number of acquisition. This is the
Exactly. Your
acquisition
customer acquisition cost was 1,000.
Okay.
Okay?
So
Your
I have to
long-term
name this number.
Right.
So
Your
why don't-
long-term value now had to be at least 5 times that you're going to get revenue from that customer.
Yeah, sure, but why I can't just name the percentage instead?
Because the same reason Guy Kawasaki talked about, you can't say we're going to capture 1.2% of the market. You have to start with the example you just gave, because every business is different. Some businesses you may be more efficient and you only need ultimately 25% of revenue. In other businesses you may need 50% of revenue. So the best way to validate that is figure out, and just like you said, if you spend so much for advertising and generated 10 customers and you spent 10K, it's 1,000 customer acquisition. That customer must be able to give you 5,000 over life. And that gets into, if it's a SaaS recurring business model, that's an attrition rate. And you'll see all this in the Pacific Crest material. Customers fall off, on average stick with something for X period of time, and then they're no longer a customer. So it's not infinite revenue you'll get from that, right? Okay. One more question, we got to
Yes,
break.
please. To continue mobile application subject, if you are paying for creation of this mobile application, isn't it a cost of goods?
Yes.
If you're hiring a developer, for example, you are paying for a...
In other words, if you're licensing the software, is that
No,
your
if you are coding. If you are paying a person who is creating the code of the application.
No, that's in operating expenses because this is a difficult point to understand. If something helps all sales, like that example you gave, you have to have a software development get paid, and then you have a product that then helps all sales. The difference is, up above the cost of goods, it's specific to that sale. So hosting costs, let me give you an example. Hosting costs, you may need, if you're on AWS, Amazon, you may need to double your hosting capacity and therefore doubling your hosting expense because you doubled your customers. But that's specific to the customers, as opposed to developing the code that was needed to support all customers. And there is some room in here, there's what's called general accepted accounting principles, does allow some interpretation here. So this isn't an absolute black line. You want to get advice from whoever does your accounting on that question.
But just to make it clear for us, if we have a product which didn't cost us anything because we did it, but to finish it quickly we need somebody, and we will pay it to...
That goes down here.
It will go down there.
Right.
So our cost of goods will be only the 30% of Play Store or App Store.
Exactly. Exactly. Anything to develop code or anything to develop a technology product or a product in general, down below. Anything when you're now selling that product, not selling, delivering that product, anything that you must do to deliver that product goes up in cost of goods.
And as you mentioned already, if you pay for Google Ads, if you pay AdWords, you can put it either in marketing or you even have a chance to put it in operation.
It will always go in operating expenses.
Always goes there?
Yes, always goes there because that you needed to do to make that sale. That example made a minute ago about if it takes 10,000 gel to generate 10 sales, that's customer acquisition cost.
Then what should be our marketing expenses?
I'm sorry?
Then what will be our marketing expenses? Just for an
your
example.
marketing expenses would be your website, your search engine optimization functionality, your email blasting to get the brand message out for your product, going to trade shows and having a booth, you're branding yourself, you're marketing yourself, okay? As opposed to now closing the sale, that goes into sales. This is okay that, because I can see that, again, there's grayness in this area. As long as it's down in this area, and this is customer acquisition cost, cost to acquire the customer, as opposed to cost of goods being the cost to deliver the product to the customer.
So when I count my customer acquisition, I pay attention to operating expenses, not marketing ones?
Sorry, ask the question again.
So when I'm calculating my customer acquisition cost,
yes,
I pay attention to operating expenses?
Correct. Correct. See, it's confusing, and I'll admit, it's confusing to use the term operating down here, but that's historic. But think of it as acquisition cost, as opposed to truly operate the product. You have to have a website. You have to have, the hosting of the website. You have to have customer support when there's problems with your product. It's specific to the delivery of the product.
Okay, thank you.
Yep. Okay, let's take a break. There's food out there. We'll get your question on when we get back. Please come back in 10 minutes, because we're already 10 minutes off. Please come back on time.
Take this one.
Thanks.
That's data. Okay.
Okay, thanks.
I had a question regarding.
Can we all come back in, please? We need to get started so we can get done for lunch. I guess we really have to work on the Georgia versus Silicon Valley time. Okay. Sorry? Yeah, please do. Yeah. Beckon them all in. All right, everybody, can you take your seats? We're going to get started, and those that aren't in the room yet will miss the information. Okay, so now that we've looked at an income statement, let me explain why it's important. It's important for investors for the following reason. Why don't you go over there? Here's the issues, and this is why this is so important. The revenues, as we talked about on that earlier slide, it's how fast is the business growing? The business has to be seen as one that will grow for the reasons I talked about earlier. Yeah, sorry. And then the flip of that is, as I said earlier, if you show too fast a growth projection, which would make your company be, if it was believed, more valuable, but the fact is you have to be credible. So that's why using that average benchmark data from Pacific Crest is so important. Your gross margin, now that you understand the gross margin calculations, needs to be within the industry standards for your industry. If you're in an app store, by definition, 30% of your revenue is going to Apple or Google. So you're automatically at 70% gross margin. But you don't have hosting costs and you don't have other things to support the product because Apple's paying for that or Google's paying for that. But you want the gross margin to be as high as possible. So if you're in a hosted business where it means not in an app store, a healthy business, you'll see in that Pacific Crest information, is 85%. Now, what does that mean? That means you have a whole bunch of money coming from that sale to do what? Improve your product, and most importantly, to spend it on sales and revenue so you'll generate more revenue. You understand why that's important? And in all startup businesses, we look for large gross margins. We will not invest in a company that's a consulting service company because why? That business typically is only 30% gross margin, and it's not attractive enough for us to make the returns we need. So we like to see 65+% in general. There are some exceptions to that, but in general. The issue here, what happens is, and why that's important, you will have ups and downs in your business. As an entrepreneur, you'll maybe get a great month. There was a famous IBM commercial a few years ago with everybody was huddled around the screen. They just launched their product, and they had creeping, almost no revenue, and then went through the roof. Well, that's the static side. But you'll also have times where, oh my goodness, So you have to, the more margin and cash flow you have available to live through the negative surprises, the better. So that's why that's very important. Sales and marketing, we've talked about this, so I'm not going to spend a lot of time on it, but customer acquisition should not be greater than 25% of your lifetime revenue from your customer. Because if it is, it means you can never get ahead of the curve. And so we look at these metrics again, look at that Pacific Crest data because we look at it and you want to be in line with it. Silicon Valley sales cost, and I talked about this earlier, on average, if it's an enterprise sale, and this is only that, 150K base, but they also get an additional bonus of the equivalent amount on a yearly basis or divided by 12 for the month if they hit their target for that month of 200,000 sales, or about $2.4 million for the year. So it's a good deal. They make a lot of money. Some Oracle salespeople made more money than Larry Ellison did in certain years where they made some really fabulous sales because they got the bonus. And then the other piece, there's about 15% you always have to have in there for travel, entertainment, wining and dining, Supra, to have your Supras with your customers, okay? Assume on average sales resources hit 75% of the target. So if you give your salespeople a target of $2.4 million, on average they'll hit 75% of that. So you want to keep that in mind as well. Online ad sales are typically driven by Google AdWords, and so that's a different model, the B2C versus B2B thing we talked about earlier. Oh boy. Okay. Now cash flow, and I apologize this chart is so tiny, but you'll get copies of it later. What is cash flow? Think of your checking book, right, if you have a checking account. Cash flow means how much money came into your checking account and why. So that was the income side of that previous chart. And then how much goes out to pay your bills and why. That was the cost part of that. And there are some nuances as you get into accounting things on depreciation and amortization and taxes and things of that nature. But that's where you need the guidance of a Deloitte or an accounting firm that can help you determine that. But what this chart is basically saying is this is really your cash flow from your operating business. So it's what's bringing your cash in and what do you have to pay out. Receivables mean somebody owes you as a customer. They owe you for what you delivered to them. Payables mean you owe somebody else for services that they provided to help you with your business. Liabilities are debt that you have in your business. Inventory is if you're building a widget, you're building up additional widgets because you're building them ahead of selling them. So you end up having inventory grow over time in this example. And then it's so on and so forth. So again, think of this cash flow as your checking account. What caused money to come in? What caused money to go out? And you always have to watch when the total amount that came in versus the total amount that came out. If you run out of money, your business is going to die. So you always have to be anticipating when that will happen and be already in a role of looking to raise new capital so that your business doesn't die. Again, there's lots of material on the internet on this that will take you through examples, and just Google startup cash flow, startup income, and you'll see it all. Now, why is this important? Why is cash flow important? I really just said it a minute ago. So the cash at the end of the period equal the top line of the balance sheet. It has to. We haven't even talked about balance sheet yet, so I'm going to come to that in a minute. When will the company run out of money? You need to know that so you can be raising new capital before it does. And will the business, this is that customer acquisition to long-term value. If that is greater than 25%, this third one will be a problem. You may never get cash flow positive because you're having to spend too much for sales and marketing relative to the amount of revenue you're getting from them. Balance sheet is the third piece. Balance sheet is assets. What is an asset? An asset is something you own liabilities. A liability is something you've borrowed for, and so if you borrow money from a bank, that's a loan and therefore a liability to you. And then equity is the difference between those two numbers. So if your assets are greater than your liabilities, you have positive equity value in your company. You probably won't have that early on, or you'll hit points where it won't be, because one asset is cash that you got from your investor, so it's in that top number up here, and what customers owe you. But there could be points where you've borrowed money or you owe for services, hosting and the like, that are greater than you brought in, excuse me, in the top part of the chart. So again, good tutorials online. YouTube's got dozens of them. And there's lots of material that will explain that in more depth. Why is that important? Basically says whether you're going to be able to pay your bills or not, and where you're getting your capital from. Return on an equity is just that. It's the return or the profits being generated based on the amount of equity that's in the company. And if you have a business that builds widgets, you have another different issue, and that is you have a cost to build those widgets before you're going to be able to get revenue for selling those widgets. And I can tell you, many companies, Silicon Valley and everywhere, overbuilt inventory before they can make sale. Even Cisco had this happen to them back in 2008 when we had the big downturn. They were growing real fast, and so they said, oh my goodness, in order to get our product to our customer as quickly as they need it, we have to build ahead of that and get inventory and keep it so that it's ready to deliver it and sell it to our customers when they need it, because they don't want to wait 3 months to get their product, their Cisco router or whatever. And then bam, the economy, global economy blew up. Dude, their forecast for new revenue, where they thought they needed and were going to get sales from that inventory, went away. They had to write off over $2 billion because that inventory became useless, because nobody was buying it. So if you make products like a Cisco router, you have a different issue to deal with. Question in the back.
How is the valuation of software inventories handled from the accounting perspective? Because, I mean, if you buy something in a traditional manufacturing process, for example, some copper finished or half-finished products, this will not depreciate in the warehouse. But
right.
Software, you can throw software away 24 months later.
That's why I was differentiating hardware from software. Software doesn't stack up as a cost. Why? Because you build the software and you spend product development money to do it. But there is no, unlike a hardware thing, where you have to go build stuff to deliver, there is no inventory. You don't have inventory with the software business. That's why we as investors prefer software businesses, because we don't have to deal with this risk of inventory. There is no inventory in software. It's product development cost, and you do have the ability to expense it in the same year, or you can amortize it over several years, but it's not inventory, because you don't spend money to build product for the next customer. Okay, now there was questions about equity. So there's something called a capitalization table or short cap table. And this gets to that. Remember that chart at the beginning where I talked about pre-money or post-money is equal to pre-money plus the amount invested. This takes you through an example of that for a NewCo. So this is who owns what part of the company. This tells you that on this chart here. Okay? And again, your financial person or your accountant will be able to keep track of this for you. But in this example, common shares, which are founder shares and or maybe family members that didn't require preferred status, each own this many shares of the company before a new investment round. The Series A, a new investor coming in now, is going to put new capital into that company. So at that point, before they put the money in, the total number of shares is only common. But once this money comes in, and I'm going to get to that in a minute, the total number of shares is going to change. You also have what are called options. And are options allowed within the Georgian financial system today? Do you understand what an option is? Okay. So let me explain what an option is. So an option is a right to buy shares at a certain price. Now, why is that important? It has tax ramifications because you don't get actual shares. You have the right to buy shares at this price, and then if the company grows in value, those options can be exercised or converted to shares at this price as opposed to the value of the company after it's grown. So management teams typically give options to their employees as they hire people to incentivize them to help make the company grow and motivate it. In the US, in a C Corp model, you have options that allow for that to happen. And I'm not going to go into all the tax issues, but it's the efficient way to reward employees as they come on, or even founders, in a way that's different than actually owning the shares. Okay, so finishing this example, there was new shares being brought in of 200,000. So you can see common stays the same. This is before and after an investment. Now that investor brought in X amount of capital, and now there are 200 additional shares because they paid a certain price per share to get those 200,000 shares. Okay, so let's say they paid $5 a share. That means they get 200,000 shares because 1 million divided by $5 gives them 200,000 shares. And then in this case, the options actually stay the same, but usually when you have a financing, there's more room, and there's difference between granted and authorized. And what authorized means is the board allows those shares to be authorized for you as a management team to grant to your employees additional shares. And you do that typically based on some compensation scheme. If they hit certain milestones, if they meet certain goals, they're going to get options. Questions on this? Okay. So I'm going to transition now. As I said earlier, my brain goes the following way. When something successful happens, it's very difficult to explain why, because it's usually many things coming together. When something bad happens or a startup fails, it's usually very clear why it happened. You run out of cash before you got to revenue. Your team is fighting with each other and they don't want to work together anymore, et cetera, et cetera. So what I'm going to go through in the next period of time, next hour, before our lunch break, is to talk through these reasons. And remember what I said earlier, you want to think about how do you prevent these things from happening? Because if you do, your probability of success of your company will go from 1 out of 1,000 to something much better than that. So these are very important points to think about every day in building your business, and don't let these things happen. Okay? So, team. Let me start with team. I think there was quite a bit of discussion about this, including, if you remember, Guy Kawasaki brought this point up, right? If you have a team that doesn't work together, or you bring in, A players hire B players hire C players, eventually you have an F company because you've allowed people to come into the company that shouldn't be in the company because they're not properly skilled. First point, the definition of entrepreneur. You're all here because you have entrepreneurial spirit. Some of you have more of it than others. And by the way, startups are not for everybody. Some people just want to have a day job that somebody else owns, and they're happy just making a salary. And they go home and they play. That's not an entrepreneur. An entrepreneur As Guy talked about and our speakers earlier talked about, wants to work almost 24 hours a day because they're so excited about the potential to become the next Mark Zuckerberg or the next Larry Ellison or the next Steve Jobs. It's a in your heart thing. I think there's a term in Georgian, but you have to have that in your heart that you really want to do this. And it's best that everybody on that team has it, but not necessarily so, because you may be able to hire some people that just want to take, as a consultant, a salary, and they're going to deliver some software for you or do some marketing thing for you. But you better have yourself as the founders and the majority of your team thinking like I said a minute ago. Don't start it if you don't feel that way, because you won't be successful. The team has to have the proper skills. Now, we try as investors to help this because every team, Silicon Valley included, has gaps. There's no team that has all the skills that we know are needed eventually. And the skill mix changes as the company grows. There's very, very few people as a CEO that start a company and stay the CEO at the exit. I happen to work for two of them. One was Larry Ellison, who made the transition, but that's a very different kind of person. And then SAIC, another company I work for, same thing happened. But here, the training, what we're bringing to you here, is so critical, because if you really take these lessons at heart, as I said earlier, your probability of success is going to go up tremendously. Single founder, I know there were people asked that question, and I know some of you are. Statistically, lower probability of success. Why? Because guess what? On a daily basis, you don't have anybody to talk to and bounce ideas about and critique each other and brainstorm with each other. You might get away with that where you get into brainstorming sessions here for a while, but very few startups are successful that have a single founder. Half-hearted attempts, I talked about that a minute ago. Do not start, because it's an opportunity cost. It's your lifetime being wasted if you think, I'm just going to do this on the side and it might happen. Don't start, because it won't happen. You have to be fully committed to doing this. And then last but not least, and this is part of how you present yourself, because we're watching for this when you're presenting. Are you confident? Do you believe in what you're doing? Because if you aren't, we're sure not going to be. And we're looking for that in your body English, if you understand that term, in how you present yourself. Exude confidence. Don't overstate, don't be bombastic and exaggerating, but show that no matter what, we're going to be successful. And I think you've heard that from several of us in the work breakouts in the afternoon. Okay, now I'm going to shift to market issues. The markets. We talked about this earlier. You've got to know your customer. Early on, engineers in general think they know what the customer wants, spend all their time building a product, launch it. Nobody wants that. Spend time, get out, talk to prospective customers, research your competition, learn from what's good from theirs and not, and apply that accordingly. Engineers are the worst case. I'm an engineer by education. Stereotyping. They tend to think they know what the customers want, and they don't 90% of the time. Not understanding your competitors. Again, my comment earlier, if you remember, we will, after your presentation, if we're looking to invest, do that search on 5 Google terms out of your presentation. And if we find 10 companies doing exactly what you said, and you said there aren't any and they're not on your competitive chart, your credibility has just been shot. Do your homework. Know the competitive landscape. That Michael Porter book that I talked about, Competitive Advantage. Strengths, evaluate your strengths, evaluate your weaknesses, look for where the opportunities are, and figure out how you're going to deal with the threats. SWOT analysis, it's called. No viable market. Again, this is back to some of us think we know what the market wants, and it's just not there. There's just not a market for it. By the way, nobody gets this right all the time. So there were many Silicon Valley investors thought there was never going to be a market for Uber. Or as a famous quote from Bill Gates way back in the 80s, we'll never need more than 640K of memory. Bill Gates said that. But my point is, you have to do your homework. You have to get out and talk to customers because that's the only way to validate there's a viable market. Marginal niche markets, marginal meaning small. You can have a niche strategy where you can build a nice, what I'd call mom and pop business, lifestyle business, but that will not be investable. You won't get investors to invest in that because remember what I said, we have to assume we're going to make 10 times the money we invest on what we invested in your company. So it's difficult in a niche market for that to happen. Derivative ideas. Let me talk about this one because it has two sides to it, and I mentioned it earlier. Apple, with that iPod, what was that? That was a derivative idea in that sense. But what discriminated and disrupted it was the buzz that Steve Jobs and Guy Kawasaki brought to the market about this is the cool thing, even though Guy and Steve knew that first Mac had no software and barely lit up. But what they were able to do is ultimately make the most usable friendly iPod, and then they did the same thing with iPhone, and then they did the same thing with iPads. They didn't invent those, so in a way you can say, well, isn't that derivative? It's derivative, but the disruption was the ease and usability and the brand discrimination that they were able to bring to the market. Lack of competitive advantage. Again, right back to knowing your competitors. If you're just one of many and you have Goliath competitors, you better find a way to not take them head on because you can't win. You can't compete directly with Oracle. You can find an area where Oracle's weak. Oracle's database products are very complex, very hard to use, but they're necessary for massive banking requirements. But if you find an opportunity to find where Oracle's not strong, like in the SMB market, you could win with an enterprise software product targeting the SMB because you can bring it in at a cost point and you don't need all that extra sophisticated stuff that an Oracle database or application requires. Some other market issues. There's this issue of timing to the market. Silicon Valley is the fastest pace that you'll ever experience in the world in terms of things happening. As I mentioned, every day there's a startup event, every day there's competitions, every day there's all kinds of events going on, and we move at the fastest speed anywhere on the earth. Not being able to keep up with you can keep up, and let me go to the flip of that. As I said, an Oracle or a large corporation, the larger it gets, the more layers of bureaucracy and decision-making get in those companies. And what that does is that causes them to not be able to innovate, and they slow down being able to make changes. So it's like David and Goliath. Goliath is a guy, the monster guy, and David was nimble enough with his slingshot to find a way around defeating Goliath. Excuse me. So you got to keep up with the market, and you have the ability because you're small and you can be nimble. But make sure you continue to look at what's happening in the market, and you have to be ready to what's called pivot and ask yourself every day, should I look at tweaking or not relative to where I am with my product strategy? You can be too soon or too late with a product. The too late's obvious. There's already big players, and you're trying to enter a market where you're too late. The too soon is not as obvious. It happened in 2000 in the US. All the stuff that ultimately came out in later, 2008 and on, was thought about and proposed in 2000. But almost all of them with the dot-com bust failed. Why? because it was too early for the market. This thing we today carry in our pockets called a smartphone has more processing capability than the space shuttle had when it launched. So it has massive capability. That did not exist in 2001. The 4G pipes, the high-speed bandwidth, did not exist. So those applications that needed that crawled, and people were not happy with their functionality, even though the same ideas, once we had the bandwidth, once we had the memory capacity, once we had the smartphones, boom, exploded. Uber would not have been successful back then because of those kind of issues. So you can be too soon to a market. So it's a difficult thing, but keep that in mind. It can happen. Value proposition, I know you've talked about this already. Guy Kawasaki got to this point. You can't have a weak value proposition. What does value proposition mean? It means if you were the customer, you have to be willing to pay at least 3 times what you're asking for the customer to spend to buy that. Because if the value is only perceived as about what they have to pay, they're not going to be excited about taking the risk of something new and different. But if they get wowed with, wow, this is going to let me go back to the Uber example. If you have a taxi cab, you have all the encumbrances and the friction of waiting for the cab, making sure the cab's going to show up, blah, blah, blah. What did Uber do? They gave you an app. You can see where Uber drivers were around your neighborhood. They gave you exactly the ETA when it would arrive. They told you exactly what it's going to cost to get to the spot you want. They took the friction out of the process. So it became a very high value proposition and has disrupted the taxi industry as a result. So focus on thinking as a customer, would you pay what you're asking them to pay by at least a factor of 2 or 3? Value proposition, very, very important. And it ties right back to the pricing strategy, right? There's different ways you can discriminate yourself on how you price something. When I first got to Oracle in 2000, Oracle was not selling software as a service. They were only selling licensed software to the end users. And Larry asked me to help lead them into the cloud business so that we could. But the pricing model at the time was massive, $30 million cost for an enterprise software license and then 20% of that every year forever to support it. Well, we got into the software service business, it changed everything. The pricing strategy was changing because in software service business, the model is not pay a massive upfront license fee, but pay a recurring fee each month to use it because it introduced the flexibility. So it took that high friction sale out where we had to pay very large salaries to those salespeople to convince somebody to buy. It took that out because the pricing strategies changed totally. And so Oracle had to learn to accommodate and deal with that changing in price strategy and come in line with the new SaaS model, which was don't pay that massive upfront license fee. So getting your pricing strategy right, aligning it with your value proposition, converting trial, the freemium thing, and then the issue as a startup, good news is AWS and Microsoft are solving this problem for you, but in the past, you do have to spend a lot of money to go build your own servers, to put your product on, to connect to the internet. Now, for the same reasons, lower friction, you can go to Azure. In fact, Microsoft will offer you as startups a certain period of time where you don't even have to pay to host on their site. And there's people here from Microsoft that you can talk to through the BizPark model that they have. But the point is, the beauty is, but the issue for the Microsofts or the Azures that are in that business, they have to stay way ahead of the game in spending a lot of money to build the servers to support the expected new capacity, just like my Cisco story a little while ago. And so if you're in a capital-intense business like that, you can get caught. Good news is it's not an issue for you, but it's a cash flow issue because if you're in that business of cloud management, you have to spend money to build all those hosting servers in those massive data centers before you're going to get money from that recurring service. Oracle had the opposite when it was selling software because the incremental cost of the software was almost zero, and it charged $30 million to put it in a new business. So it had the opposite. But as soon as SaaS happened, I had to figure a way while I was there to manage the timing of how fast we ramped up our server farms so that we didn't get too far ahead, but stayed far enough ahead so that we wouldn't have performance problems. AWS, Microsoft Azure, they all have that potential risk. I already talked about the last one. Don't try to compete head-to-head. Find a way around competing head-to-head with the giants. Okay. Execution. This is very, very important. You've got to be focused. Again, this can't be a side job. And you, as the leaders of your team, you have to look to how you're optimizing whoever you have on your team every day. You know, it's a very, very difficult task to be the CEO of a company, startups included, because you have to keep the people motivated to want to continue to work very hard and continue to succeed. At the same time, you have to balance how those resources are being used on a day-by-day basis. There's also another risk that comes into this, and it's a very important capability of what's called the product development function in a company. Let me explain how that works. At Oracle, I was on what was called the Product Development Management Council with Larry, the CFO, the head of development, the head of support. And what we would do is monthly meet with the salespeople that would come in, and they would say, our customers are asking for something we don't have, XYZ. The issue then was we went to our product development teams and said, okay, how much is it going to cost to build this? And is there a big enough market for us to want to do that? Here's the issue. The issue is sales, as you grow, this will become more and more and more of an issue because you'll have what's called the McDonald's versus Burger King problem. What is that? McDonald's, when you go there, you don't get a choice of how the hamburger's delivered. It's the McDonald's way. Burger King, you have an option. You can have it with or without the tomatoes, with and blah, 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 right? In software businesses or any businesses, all customers want Burger King. They want it their way. But you as a company, and particularly the product development role, is so critical because if you allow every customer to have a custom solution, you will never get the proper gross margins because you've got every customer's different, and you're more like a consulting company than you are a product company. So you have to control, and you as in a startup, it's typically the CEO has to make this decision. If you see some customer wanting some customization of what you're bringing, you have to make sure one of two things, which we did at Oracle. You have to either price it so that you can make a profit on a custom solution, so meaning paying a lot more, or you have to say no and convince them to buy the McDonald's hamburger. Do you understand that point? Because if you don't, if you allow every customer to want some custom configuration of what you're selling, your business will spin out of control because you can't know in the software business every software solution is configured differently. Now, the beauty of software as a service is it controls that intrinsically because you're typically not going to allow custom solutions to those customers because it's a single instance source. But be careful about thinking the opportunity cost of zigging and zagging, and when a customer wants something a different way, whether it's worth doing that and and price it accordingly. What we did at Oracle, we had something called a CHEMLI. I forget what the acronym is. Customizations, blah, blah, blah. What we did is, in order to get them to be buying McDonald's instead of Burger King, we said, we'll give you the Burger King model, but depending on your customization score, it's going to cost you 10, 20, 50, 100% more. Changes the behavior of a lot of customers. Instead of them saying, okay, you need to modify to work within our environment, we convince them because of the price differentiation to take our McDonald's hamburger instead of their custom Burger King hamburger. Very, very important point. So that's this not focused. You have to stay focused on this point. At the same time, and this may sound counterintuitive, you have to be agile. This is where you have an advantage over those big companies. Remember what I said, right? The term here, and again, another book that Eric Ries, I think I mentioned to some of you, wrote the book, The Agile Startup. And it ties in with what Moses was talking about a couple days ago in the Scrum process. What you have to recognize is your product, when you pivot, when you decide that you should change your product strategy, is a very difficult thing to do, but here's the way you should think about it. And I do this in my personal life. Every day I wake up and I ask myself, okay, there's 30 things I could do today. Which one of those is going to give me the greatest return on my time? And which ones are going to be lower return on my time? You have to ask yourselves that as entrepreneurs every day. As a team, what do we focus on today? And you're looking at, if you decide to change, it's called opportunity cost. The opportunity, when you change, means you're not going to be able to do what you were doing because you're changing. So you have to weigh the impact of changing, which may be necessary because your product idea isn't quite right and dying off, versus staying on that path. Opportunity cost is the point. So you have to be agile, and you have to keep asking yourself that question every day, because there'll be new competitors coming in the market, conditions will change, et cetera, et cetera. And by the way, I think I said this to some of the breakout groups in the afternoon, 90% of the time, the business plan we initially invested, by the time we exit the company, is very different, because those companies knew and were successful in pivoting at the right time to be successful. Product shortfalls and weaknesses. In my example earlier, there's always gaps. You're never going to have a product that everybody wants, and you have to manage that. Do I change it or not? But this is the constant staying with your customers, the constant feedback after you launched your product, to be constantly getting feedback from the customers. Set your website up if it's a web-based thing. Have it where customers can comment directly on your website to give you feedback on things you don't have. Large companies like Oracle, we have what we call user groups. So we would bring CIOs from the top 500 Fortune 500 companies together at Oracle World every year, and we'd ask them that very question. What do you like about the product? What aren't we giving you in the product? And even Oracle had shortfalls and weaknesses. So you need to understand those, and you need to understand what your competitors are doing, because if you get blindsided and you don't stay up with your competitors, you're going to have a diminishing return business. Poor product management discipline. This is what I talked about a minute ago. Earlier on, you as the CEO have to have that discipline to know when to zigzag and think about opportunity cost of doing it. The time to break even. Okay, nothing more important than this from going back to our financial statement. Let me get to this point, because now that you've seen how a financial statement works, it's a simple relationship. Oops. I'm the world's worst writer on a board, so I apologize. You're probably not going to read this. But in a business, if this is cost and or revenue, and that's time, your cost to deliver your product is going to go like that. Over time, yeah, okay. There we go, great, thanks. And then, if you have a product that the world really wants and needs, you're going to have a curve on revenue that's going to go like that. Okay? What is this? What is that? That's the difference between cost, if this is revenue. Sorry again, I apologize for, I got an F in grammar school for handwriting because I can't even read my own handwriting. And this is cost. Difference between cost and revenue. Remember the checking account. This is money out. This is money in. What does that mean? This is the amount of capital you must have in order to get to what's called cash flow break-even, where your cost and your revenue equal each other. Okay, very important point. What you want to do is find ways to change this curve so it's less, and you want to find ways to enhance this curve so your cost to cash flow break-even is only that much. You have to ask yourself, that's why these financial statements are so important. Because as an investor, we look very hard at this. I'm going to step back for a minute because there's a little sidebar here. There was a period a year ago when the craziness of Silicon Valley was happening again, and it was, oh, don't worry about getting a cash flow break-even, just continue to drive to get revenue, even if we burn, and some companies like Uber were burning $3 million a month, meaning their costs were $3 million more than their revenue a month. They were raising a lot of capital so they can afford to do it. But suddenly, last fall, the venture capital world said the public markets went into a hiccup, which means it was going to be very hard to IPO a new company because the public markets weren't going to want to spend money on an IPO. The economy globally kind of took a hiccup. So suddenly, the idea of just keep growing because the economy's growing changed to you better get the cash flow break even as fast as possible. My philosophy has always been through that whole period, don't listen to those venture capitalists that tell you not to worry about getting the cash flow positive. Because I've been an entrepreneur, I've been in your shoes, okay? The sooner you can get to that point or here, what does that mean? It means you don't have to take more capital to stay alive. Why? Because your revenue's greater than your cost. So that means you're generating income. And you can live off of that, and you don't need to take more capital. You may take it because you want to accelerate your growth curve, but you don't have to take it. So you as an entrepreneur are in a whole different position relative to when you have that discussion about valuation. You're in a stronger position because you can say, I'm not going to take I don't need your capital. So you have a leverage that's different. So empathetically, as a startup guy myself, different than as an investor, I would tell you every day, ask yourself, how do I close that gap between cost and revenue? What can I do differently? How do I make the product more attractive so that more customers are going to want to buy it without having to spend more money? Or how do I sell my product more efficiently? Or how do I build the new functionality more efficiently? Or how do I reduce my costs? And the other rule is, do not get in a startup, minimize fixed cost. And what is fixed cost? It's taking and committing to a 2-year lease for your office. That's fixed now. No matter what happens, you have to pay that bill. You're much better saying, nope, I'm going to rent on a monthly basis if you even need an office, or better yet, I'm going to work from home or work from here. Keep your costs variable so that you can, because you will always have hiccups in this revenue curve. It won't go just like that. It will actually go like this. And so the more you have variable costs to change and reduce this, the better off you're going to be. Don't get into fixed costs wherever you can help it. Do you understand this point? This is very, very important to your success and survival. Focus on getting to where your revenue and your costs cross over. Think about things you can do differently to make that happen. Okay? Thanks. All right. And again, I apologize for awful penmanship. Okay, so that gets to this agility thing, shortness of weakness, the product management discipline, and the cost of customer acquisition. We talked about this one, but this gets to pricing strategy. Because if you come up with and you figure out, and you will over time, that it's taking, and it will cost more early on, that it's taking 100 gel to land a customer, but you're only generating 100 gel in revenue, you have a problem. Because you're never going to make a profit. You're going to have spent the money, and you'll never have crossed that cash flow break-even point. So you have to have that ratio being 4 to 5 to 1, where what you're going to expect to get from a customer in long-term lifetime revenue is at least 4 to 5 to 1 what you're going to have to spend to acquire that customer. Make sense? I know some of these may or may not. Okay. I'm actually, we're going to get done early, so we'll get the break sooner than 1. Okay, execution again, some more execution stuff. This is this question, the point I brought up earlier about taking capital. And there's 2 perspectives that startup entrepreneurs have. Most of them want the comfort of having a lot of money raised early so they don't have to worry about it. But when you do that, remember you're going to give up more ownership of your company, because the value of your company is going to be less at that point than it would be if you took that money later. So keep that in mind. And as Guy talked about and I've talked about, projections are almost always too rosy. Do not do we're going to capture 1.2% of a $1 trillion market, because that's always too optimistic, and you have no basis to say it's 1.2 or 0.2 or 0.8. You're much better off doing that bottoms up, as he talked about, where you figure out what your customer acquisition cost is, and you figure out what the expected lifetime value of that client's going to be, and don't put too rosy a forecast in your model. The cost to deliver a product is almost always underestimated. So the flip, your revenue numbers are, we as humans, as entrepreneurs, are success oriented. We think you have to. This is the contradiction of being an entrepreneur. You have to be positive. If you're not going to be a successful entrepreneur. But you also have to be realistic, and that Pacific Crest benchmark data I talked about helps you be realistic, because it tells you what hundreds of startups took to get to where you're going, the successful ones. By the way, it doesn't even talk about all the ones that failed, because guess what? They don't have any statistics because they failed. So that's the successful one. And it's always almost the revenue forecasts are too rosy and the costs are too underestimating what it will cost to build your product. Believe it or not, that can happen. You can get too much capital. Let me explain. There's a great example of this from a few years ago. A company raised a $15 million round in Silicon Valley, and they decided to do a Super Bowl commercial, which is the most expensive commercials on earth. $5 million. $5 million for a 30-second commercial. $5 million. And they said, we're going to get the entire world, because the world watches the Super Bowl. Well, they did 2 30-second ads, used $10 million of their raise. They were out of business 6 months later. They had all of this money in the bank. They thought, wow, you can have too much capital. Because what I mean by that is you're not thinking of it the right way in terms of risk managing that use of those funds. So think of, if you do take capital from Gita or from investors, don't think that way. Think of it as money that you put into the business. And how would you spend it if it was your money? Don't do the opposite. Don't buy the $5 million 30-second, because you wouldn't do that if it was your money. I understand that point. So don't spend too fast. Spend every dollar like it's your last, spend every dollar like it's yours. And balance the product release against the customer uptake. Of course, the opposite side of that is if you're too slow getting the product to market, other competitors are going to come. If you have a great idea, I can guarantee you somebody else is going to have that great idea eventually. So you have to stay constantly in a mode where you're keeping track of what others are doing and staying ahead of that. Because in a software business, excuse me, in a software business, you have a different scenario here. You have the ability to drive customers, and your cost of building the product, your incremental cost to deliver to your next customer is very, very, very small, approaching zero, once you already have the product. So that's the advantage. But you also have to take whatever cash is coming in, whether through investors or through revenue, and make sure you're keeping up with your competition. You can launch too early. You know, the point Guy made about, well, you're better to do the flip, this is an area where I'd caveat what he said a little bit. Because if you have too buggy a products, when Oracle first released, I was there at the time, when Oracle first released its first web-based, going from client-server to three-tier architecture, it was buggy as you can't believe. And we got incredible negative feedback from the customers. Larry just wanted to get it out and let the customers find the bugs, and then we'll fix them. You can go too soon. So again, there's no, I can't give you, here's a cookbook answer to that question. But what I can tell you is, you want to test your product as best you can to make sure that it's not buggy, because that can kill your business. If the reputation gets out there, and social networks do that now, you could be dead. And no matter what you do to try to recover from that and make the product perfect, the word out on the street is, this product's too buggy, don't use it. So balance that. Do enough testing to ensure that you're getting a product out that you'd be okay with using at that point. This can actually happen too, growing fast, believe it or not. Let me explain what that means. And I didn't really go into it earlier, but there's a term called working capital. Working capital. What does that mean? That means when you sell something, before you get the revenue for it, you have to have spent money to make that happen. So you have to spend money before you get revenue for that. And the good news is, with a software product where you're doing an online credit transaction, the good news is the time from when a customer buys it to you get paid is instantaneous. But that's not typically true with most products. You sell a product to somebody, and then they have 45 days to pay you. But in the meantime, you have to pay all your vendors or your people and your salary. So the difference between money coming in, money going out, if you grow real fast, think of it this way, if you grow real fast, that number gets bigger and bigger and bigger and bigger, and you can run yourself out of business because you grew too fast. So this is where having someone with an accounting background to guide you and watch for that kind of an issue, because there are financial metrics that will flag if that's likely to happen. So, and a good accountant that understands specifically startups will be able to help protect you against overgrowing. Now, there's a solution to that, and the solution is, once you have enough revenue and you're profitable, you can go to a bank. So in Silicon Valley, we have a bank called Silicon Valley Bank, or that caters to startups. They will do what's called a working capital loan line. So that means that gap, so they will actually lend you the money to cover, but because you're growing real fast, they're willing to lend you the money because they see you're going very fast and you're going to end up paying that back. But you can't get to that until you have enough revenue and profitability. The other thing, we're growing too fast. This is maybe, again, one of the important takeaways. In fact, Google still does it today. I think we talked about this the other day. Moses, I think, brought it up. The interview process to get hired at Google today, where they have, I think, 30,000 employees today, it's a 6-month process. Why? Because they want to make sure they're hiring the best. As a startup, you cannot afford to hire B players. You cannot afford to hire somebody that's going to be disruptive and not fitting with the rest of your team, because it will kill you, especially when you're an early company. So interview, make absolutely sure before you hire somebody on your team, preferably do what I call try before you buy. Bring them in as a consultant first, see how they work, before you commit to hiring them as an employee, which is variable versus fixed cost again. But interview, because critically, and when you're growing fast, it gets harder and harder to do. Because everything's going at an infinite rate, and you got to get people to do it, but you can really hurt yourself in the process. Okay, just a few more slides. I think maybe 2. All right, location. In the US, the vast majority of successful startups are in a couple areas in the country, because the ecosystem is developed there that supports them as startups. So one of the things Geeta is doing a great job here of is helping to build your ecosystem. And we've been talking about bringing your universities more into the process and getting the community, but just statistically, in areas outside of these key areas, you're less likely to be successful. Now, how do you solve that, being that Georgia's up and coming? Well, there's ways to do that. I invest in what I call cross-border companies, different parts of the globe, Poland in particular now. Basically, what I do is I'll find an interesting company in some emerging market in some part of the world, and I'll then reincorporate that business as a U.S. C Corp so that I can raise capital in Silicon Valley, because I can't, nobody will fund a Georgian or a Polish or a Russian or a China company from a U.S. venture fund, because they don't know the laws, they don't know how that their money will be protected, it has to be a U.S. C Corp, and ultimately to go public on a U.S. market has to be a U.S. C Corp. So we do that, but then the typical gap we find is global sales and marketing talent that we will put in the U.S. that in one of these corridors, so that the company now has an automatic extension into those ecosystems to improve your probability of success and help you find the right people to do your global sales, experienced players to do that, or maybe experienced product development managers, or et cetera, et cetera. This one tends to get underlooked by most startups, customer support, and it can be a death knell for you. Because you may be bringing a lot of customers in, but because they're not happy because you're not paying attention to them enough, or your buggy product and you're not fixing it enough, they go away. And so you can actually, in fact, you'll see on the Pacific Crest data again, the concept of churn. Churn means what's the average time a customer stays, or let's say it's a 90%, let's say it's a 90% churn. That means 10% of the customers each year go away. And so you have to replace those. If your churn gets up to 30, 40, 50%, even if you're getting new customers at a very rapid rate, if you're losing more customers than you're gaining, guess what? Your business is going out of business, even though you're getting lots of new customers, because primarily you're not focusing enough on them from a customer support standpoint. And last one on this chart, channel strategies. Best example I can give you, and this is an important one, small to medium business chasing that market. Customer acquisition costs tied to that. You cannot effectively sell to a small to medium business, or it's very difficult to do that if you're having to find those customers new. I'll explain what I mean by that. There's a concept in sales called farmers and hunters. Hunting means you have to go hunt and find a new customer. Farming means you already have them as a customer and you're delivering them something new. The cost of hunting versus farming is 5 times more expensive. 5 times more expensive. So, how do you solve that? It's very expensive if you're trying to go after small to medium business. But if you look for a channel partner that's already selling them, that already has them as a customer, and you agree to work through them as a channel, guess what? Now that's farming, not hunting. So finding channel, getting the right channel strategy is also a very important point here. Last slide. CEO has to be doing everything, taking the trash out, bringing lunch in, bringing the pizza at 3 o'clock in the morning, as does the rest of the team. You got to get your hands dirty. Everybody's got to be working as hard and doing the same things when you're on an early startup. I talked about hires. You cannot afford to make bad hires when you're a startup, so interview, or do try before you buy, where you bring them in as consultants. And then, if you prevent all of those things from happening, sometimes, excuse my French, shit happens, as the term in Silicon Valley is. You just need to know to recover from that. You need to know that things will come back the next day. You'll have another chance. Be resilient. Get back up. Take the punches. Think through how you're going to do better the next time, and learn from it and grow. That's it. Questions? Comment?
So my question is regarding the channel partners.
Yes.
So it's very important, as you mentioned, to get the right channel partners. It turns you from hunter to farmer.
Yes.
I've got it correctly.
I'm sorry?
Am I got it correctly?
Yes, absolutely. Because they have them already as a customer. So their cost to convert them for the sale, because they already have a relationship with that customer. So that customer is more likely, by a factor of 5, to buy from them than you, because they don't know you. They know that other company. Now, and what you have to do to get that channel share, you have to give some of your revenue to that channel partner, because they're not going to do it to be nice. So, but if that cost that you give them, say, 20% of the revenue is less than you having to spend to get the customer directly, you should do that.
Another question, does it contribute to the reduction of customer acquisition cost? And does it look complex channel strategy for VCs to have partners?
It's a question of timing when and the type of product, right? There's another concept of market making versus something where there's already a known need. If you have to go make the market, which means educate the world to that there is a need for it, that's different than if they already realize there's a need for it. But channel strategy, we look and try to actually help with the right introductions. But you have to, because I used to be on the other side of this at Oracle, I'd have every startup in Silicon Valley coming to us wanting to channel partner with us. Why? We had 30,000 salespeople around the world, and startups would say, well, you know, wow, Oracle will do all this for it. Oracle or that partner has to believe they're going to get more out of partnering with you than you believe you will get out of it. So you have to flip around and pretend like you're in their shoes and make the relationship such that that will happen, which means typically giving them 20 to 30% of your revenue for that sale, because their cost for that sale will be much smaller because they have them already as a customer in farming versus you having to do it.
Thank you.
Any other questions? Arthur?
Thank you, Mark, very much. I would like also to speak in Georgian because
Sure.
I would like to explain the procedure for tomorrow and for next week, and I want to be very precise and everyone should
Please.
understand it very clearly. ამიტომ გავაგრძელებ ქართულად. ეს არის ბოლო შეკრება ესე ერთად, უკვე დღეს დღის მეორე ნახევარში ისევ გუნდებში გადანაწილდებით და გაგრძელდება თქვენ პრეზენტაციებზე მუშაობა. ხვალიდან უკვე იქნება ვარჯიში, ასე ვთქვათ, პრეზენტაციები, რომელიც თითოეულმა თქვენგანმა უნდა წარმოადგინოთ და შემდეგ უკვე ჩვენ ერთმანეთს მემშვიდობებით 4 შაბათ, 5 შაბათამდე, სადაც შეხვდება უკვე მთავარი ფინალური თქვენი პრეზენტაციები ვენჩერული ინვესტორების წინაშე. მინდა აგიხსნათ ის ქცევის წესები, რომელიც ჩვენ შევიმუშავეთ და რომელიც მნიშვნელოვანია, რომ იცოდეთ წინასწარ მომზადებული იყოთ თითოეული დღისათვის. თქვენთან უკვე გამოგზავნილია მეილი, სადაც გთხოვენ, რომ დღეს 5 საათამდე აუცილებლად პრეზენტაციის ის ვერსია საბოლოო, რომელიც გაქვთ, თქვენ უნდა გადაუგზავნოთ ჩვენს გუნდს, რათა ხვალისთვის ყველაფერი მომზადებული იყოს. ხვალ იქნება ზუსტად ისეთი ანალოგიური და პრეზენტაცია იქნება ერთი-ერთში, ასე ვთქვათ, რეპეტიცია იმისა, რაც უნდა იყოს 4 შაბათს და 5 შაბათს. განსხვავებით იმისა, რომ ერთ დღეს ჩატარდება ეს უფრო მცირე დროთი. დანარჩენი იქნება ყველანაირად იგივე. განსხვავება 4 შაბათს და 5 შაბათს ასევე იქნება ის, რომ ჩაწერა იქნება როგორც ყოველ დღე ვიწერთ, ისე მოხდება ჩაწერა თითოეული პრეზენტაციების, თუმცა უფრო მეტი კამერა იქნება, ეს იქნება განსხვავება მხოლოდ. დანარჩენი არა, შესვლისას ასევე თქვენთან შეიძლება მოვიდნენ ჟურნალისტები, გამოგართვან ინტერვიუ და ასე შემდეგ, ამისთვის იყავით მზად. ასევე მნიშვნელოვანია, რომ ძალიან დიდი ყურადღება მიექცევა თვითონ დაბარების საათებს. ყველას ხვალიდან უკვე ყველანი არ მოდიხართ დილის 9 საათზე, არ რჩებით 5 საათამდე. თითოეული სტარტაპისთვის გაიგზავნება ინდივიდუალურად დრო, სადაც იქნება ის დაბარებული. ზოგი სტარტაპი იქნება დაბარებული 9-ის ნახევარზე, ზოგი 10 საათზე და ასე შემდეგ. იმ საათზე, როდესაც არის სტარტაპი დაბარებული, თუ არ გამოცხადდა, არის დისკვალიფიკაციის საფუძველი. გაითვალისწინეთ ეს და აუცილებლად როგორც ხვალ არის ზუსტად ერთ-ერთში იგივე ანუ დაგვიანებები დაუშვებელია. როგორც ხვალ, ისე 4 შაბათს და 5 შაბათს არ გადავა შემდეგ გუნდზე და არ დაბრუნდება შემდეგ თქვენზე რიგი. შესაბამისად გავითვალისწინოთ, ღმერთმა არ ქნას ახლა რაღაცა თუ ხდება, შეგვიძლია დაგვირეკოთ და ასე შემდეგ, თუმცა დაგვიანებები დაუშვებელი არის. ყველაფერი გადაიცემა პირდაპირ ეთერში, განსაკუთრებით 4 შაბათს და 5 შაბათს და ძალიან მნიშვნელოვანია, რომ მივაქციოთ დაგვიანებებს ყურადღება. და ასევე როგორც ვატყობ, ყველა გუნდი არ არის და გთხოვთ ეს ინფორმაცია მიაწოდოთ დანარჩენ გუნდებს. ასევე შემდეგი წესი, რომელიც უნდა იცოდეთ, პრეზენტაციაზე დაიშვება გუნდიდან მაქსიმუმ 3 ადამიანი. უნდა განსაზღვროთ, ასევე წინასწარ უნდა გითხრათ, რამდენი ადამიანი არის თქვენგან წარმოდგენილი პრეზენტაციაზე, რომ შესაბამისად მოვამზადოთ ინფრასტრუქტურა, მიკროფონები თუ ასე შემდეგ თითოეული ამ ადამიანისთვის, რომელიც მიიღებს მონაწილეობას. ასევე მიაქციეთ ზოგადად პრეზენტაციისას ყურადღება, რომ როდესაც ერთი შედის, კი ბატონო შედის CEO და ის ვალდებულია ყველაფერი იცოდეს, ხო? თუმცა თუ შედიხართ გუნდთან რამდენიმე, ეცადეთ რომ გუნდზე გაანაწილოთ, იმიტომ რომ ინვესტორებმა დაინახოს, რომ გუნდი მუშაობს. თუ ერთი პასუხობს, მაინც ჯობია რომ ერთი შევიდეს და ერთი ისაუბროს, რომ არ ჩანდეს, რომ ის დიქტატორია, ასე ვთქვათ და ის მართავს პროცესებს და ასე შემდეგ, ესეც მნიშვნელოვანი კომპონენტი, რომელიც უნდა გაითვალისწინოთ. არის? ერთი წუთით კი. ხო, სავიზიტო ბარათებიც აუცილებლად გქონდეთ, თუმცა პრეზენტაციის დროს არ მოხდება იმის დარიგება. ძალიან შეზღუდული ხართ დროში და ძალიან მკაცრად განკონტროლდება დრო, ის რომ ანუ 7 წუთში პრეზენტაცია უნდა მოახდინოთ და მხოლოდ 7 წუთია ფიდბექი და მაქსიმალურად ეფექტურად უნდა გამოიყენოთ ეს დრო და ასევე ყველანი, როდესაც დაბარებული იქნებით იმ დროს, აქ არ ამოდიხართ, მესამე სართულზე არ ამოდიხართ, მესამე სართულზე ამოდიხართ მხოლოდ ჩვენი გუნდის წევრის თანხლებით, როცა მიგითითებენ. თქვენ იქნებით პირველ სართულზე, ფაბლაბის ერთ-ერთ ოთახში განთავსებული, მანამ სანამ უკვე აქ ამოხვალთ. თუმცა ტელევიზიით შეგიძლიათ მიადევნოთ თვალყური, პირდაპირ ეთერში იქნება გადაცემული ეს პრეზენტაციები და როგორ მიმდინარეობს და ასე შემდეგ. და შემდეგ უკვე შეხვდით. კითხვები კი ბატონო. არა, ხვალად ზუსტად ისე, როდესაც დაგიბარებთ, იმ დროს უნდა მოხვიდეთ. ხვალინდელზე გამოგზავნილი არის რაც შეეხება ხო, მან კიდე რაღაცები შეიძლება შეიცვალოს, მაგრამ ნებისმიერ შემთხვევაში. ასევე გაითვალისწინეთ, რომ გაითვალისწინეთ, კიდევ ერთი მომენტი დამავიწყდა, რომ მეთქვა. თქვენ პარასკევს ხვალ როდესაც გექნებათ რეპეტიცია მთელი დღის განმავლობაში. ჩვენ შემდეგ ვწყვეტთ ურთიერთობას 4 შაბათამდე და თქვენ გაქვთ დრო, რომ კიდევ ერთხელ გადახედოთ თქვენ პრეზენტაციებს, შეიტანოთ საბოლოო შესწორებები და სამშაბათს შუადღის 12 საათამდე არის ბოლოვა და საბოლოო პრეზენტაციის გამოგზავნის. ესეც ასევე იქნება დისკვალიფიკაციის საფუძველი. სამშაბათს 12 საათამდე აუცილებლად უნდა გამოგზავნოს საბოლოო პრეზენტაცია. შუადღის 12 საათამდე. სამშაბათს შუადღის წინა დღეს შუადღის 12 საათამდე.
უკაცრავად, ყოველ დღე ჩვენ როდესაც გავდივართ ტრეინინგს პრეზენტაციის ჩატარებაზე, შემდეგ ვაკეთებთ ცვლილებებს ამ პრეზენტაციის. იგივე იქნება დღეს და დღეს 5 საათამდე არ ამგონია რომ მოასწრონ ყველამ გამოგზავნა ასე ვთქვათ საბოლოო პრეზენტაციებს.
გავიგე. დღეს 8 საათამდე შეძლებთ გამოგზავნას.
ნუ აი, არ ვიცი ეს
იცით როგორ არის, ანუ ეს ხვალინდელზე კიდე რაღაც გამონაკლისი შეიძლება, უბრალოდ ანუ event management-მა უნდა მოასწროს ამ ყველაფრის პრეზენტაციების გადატანა კომპიუტერში და აღრიცხვა და ასე შემდეგ. მაშინ ესე ვთქვათ, რომ 9 საათამდე დღეს მოგვაწოდოთ.
კარგით.
9 საათამდე იყოს.
მეც დავამატებ, იმიტომ რომ ანუ ალბათ შემსავით არის ხალხი, რომლებიც აქედან მივდივართ და ვმუშაობ თან და სამსახურის მერე ვაკეთებ, კიდევ ვმუშაობ პრეზენტაციებზე და ხშირად თავდება ხოლმე ღამის, არ ვიცი, ჩემთვის მაგალითად 3 საათზე და ალბათ დროში შეზღუდვა არ უნდა მესმის რომ იქ ივენტ ორგანიზერმა უნდა გააკეთოს და დააწყოს პრეზენტაციები, მაგრამ ანუ ეს ყველაფერი კეთდება იმისთვის, რომ ჩვენი კეთილდღეობისთვის, ხო? შესაბამისად ალბათ რაღაცა flexibility უნდა გქონდეს, რომ თუნდაც გვიან გადმოვაგზავნო ღამე პრეზენტაცია, იმიტომ რომ ხო
კი ბატონო, დღეს რაღაც კარგით.
ნუ არ ვიცი, მე შეიძლება ღამე გამოგიგზავნოთ უფრო გვიანო.
დილით ადრე მოვა ჩვენი მენეჯმენტი გუნდი და გააკეთებს.
ჩვენ ვიყენებთ ვიდეოს პრეზენტაციაში. ფაილი არის დაახლოებით ხო, ფაილი არის დაახლოებით 300 მეგაბაიტი.
კი ბატონო.
გადმოგზავნისთვის ალბათ ვიტრანსფერი გამოვიყენოთ, დიდი ფაილი თუ არის
ხო, ან ფლეშკით შეგიძლიათ მოგვიტანოთ და ასე შემდეგ. ეს პრობლემა არა, უბრალოდ ასევე კიდევ ერთი რაც მინდა ვთქვა, ანუ თქვენ ვიდეოს უშვებთ, თუ რაღაცა ფიზიკური პროტოტიპი უნდა მოიტანოთ და პრეზენტაციისას უნდა აჩვენოთ და ასე შემდეგ. ესეთი დეტალები, რაც ჩვეულებრივ ვრცილდება, ჩვეულებრივ PowerPoint პრეზენტაციას, ასევე წინასწარ უნდა იცოდეს ჩვენო მენეჯმენტის გუნდმა, რომ დრო არ დავკარგოთ. მეილშივე მოგწეროთ თვითონ ინდივიდუალურ გუნდთან. ასევე მოგწეროთ ადამიანთა რაოდენობა, სახელი, გვარები, რომლებიც მიიღებენ საბოლოო პრეზენტაციებში მონაწილეობას.
და ხმაზე კიდე, ხმაც ალბათ იქნება, ხო, შეერთებული. დავწერთ მეილში მაინც, მაგრამ
რა თქმა უნდა.
მადლობა. პირველი კითხვა არის ასეთი, რომ მაგალითად მე და კიდე რამდენიმე ადამიანს დავინახე ვიყენებთ Apple-ის ლეპტოპს. შესაბამისად პრეზენტაცია არის Keynote-ში და არა PowerPoint-ში. Keynote-იო გამოგიგზავნოთ, შეგეძლებათ გაშვება მაგისი?
რა პრობლემაა ვერ ხვდები?
ო, ძალიან კარგი. არ არის ეგ პრობლემა, Keynote-ს გამოგიგზავნოთ მაშინ და მეორე კითხვა. Windows-ი არ უშვებს რა და პრობლემა ეგ არის და არ ვიცი ხა
Windows თუ არ უშვებს, Apple-ის კომპიუტერში შევუერთებთ.
შო, ძალიან კარგი. მეორე კითხვა ასეთია, რო თქვითო ხვალ იქნება 4 შაბათს და 5 შაბათის გენერალური რეპეტიცია იგივენაირად. ხვალ რატომ გრძელდება 1 დღე და მერე 2 დღე, ანუ განსხვავება რა არის მაგორ შორის?
განსხვავება არის რაოდენობაში. თუ უბრალოდ 7 წუთიანი პრეზენტაცია გაქვთ ხვალაც და 4 შაბათ 5 შაბათს, უბრალოდ ფიდბექი არის მხოლოდ 3 წუთიანი ხვალ. და 7 წუთიანი კითხვა-პასუხი იქნება უკვე 4 შაბათს და 5 შაბათს. შესაბამისად ვერ ეტევა გუნდები. ასევე გაითვალისწინოთ, რომ 5 შაბათს 3 საათზე მთავრდება ზოგადად ყველაფერი და 6 საათზე ყველანი უკვე ისევ აქ ვიკრიბებით. თითოეული სტარტაპი უბრალოდ 6 საათზე იწყება უკვე პრეზენტაცია შესაბამისად 6-ის ნახევარზე უნდა იყოთ აქ. საქართველოს პრემიერ-მინისტრი გიორგი კვირიკაშვილი გამოაცხადებს 6 საათზე უკვე გამარჯვებულებს და 5 შაბათს უკვე გვეცოდინება ის გამარჯვებულები, რომლებიც მიიღებენ ჩვენგან დაფინანსებას. უკვე გამოგზავნილი არის. საბოლოოდ არ ამგონია რომ რამე შეიცვალოს, თუ რაღაც შეიცვლება, ისევ გამოიგზავნება, საბოლოოდ გამოგზავნილია.
მე მაქვს ერთი შეკითხვა თუ შეიძლება.
გავარკვევ და გადმოგიგზავნით. დიახ. არა. და დამსწრეები არ იქნება. ეს იქნება დახურული შეხვედრა, იქნება მხოლოდ აქ იჯდებიან ვენჩურული ინვესტორები, რომლებიც შეგაფასებენ და აქეთ იქნება ძალიან მცირე რაოდენობა ადამიანი, ჩვენ ვიწვევთ ქართველ ინვესტორებს, რომელთაც აქვთ დაინტერესება ქართულ სტარტაპებში თავიანთი სფეროების მიხედვით. ზოგ შემთხვევაში შეიძლება მოვიდნენ, ზოგ შემთხვევაში შეიძლება არა. ნებისმიერ შემთხვევაში ეს არის დახურული ღონისძიება.
ანუ დავუშვათ გუნდში ვართ 3 და 1 აკეთებს პრეზენტაციას. ანუ ჩვენ დანარჩენი 2 ვერ დაესწრება? ანუ მაგის კითხვა მინდა.
დიახ. ესე არის.
ანუ ვერ დაესწრება?
ვერ დაესწრება.
ანუ რატო?
ანუ ამ შემთხვევაში თვითონ თქვენ თუ გნებავთ შეიძლება 3 ადამიანამდე შეიყვანოთ იქ. ეს უბრალოდ რეკომენდაციის სახით მოგეცით, რომ თუ 3 შეხვალთ, ჯობია რომ მიზანი კონდეს, რომ ანუ მათ რაღაცა უნდა უთხრათ.
ერთი CEO-ა, ერთი CTO-ა, რამე ტექნიკური კითხვა
კი ბატონო, შეგიძლიათ 3 კაცამდე შეგიძლიათ შეიყვანოთ. არა. სამი ადამიანი არის პრეზენტაციაზე და მაქსიმუმი რომელიც შეიძლება დაესწროს. დიახ.
ხვალინდელ დღესთან დაკავშირებით რომ დავაზუსტოთ 9 საათი გადაწყდა თუ 12 დღეს პრეზენტაციის გამოგზავნის ბოლოვა და
ბოლოვა და არის საღამოს ღამის 12 საათი.
ღამის 12 საათი, გასაგებია, მადლობა. არა, დღეს და სამშაბათს დღის 12 საათზე.
დღის 12 საათამდე არის ბოლოვა და უკვე თქვენ გაქვთ დრო მთელი შაბათი, კვირა, ორშაბათი და საბოლოო პრეზენტაცია.
და კიდე ერთი შეკითხვა, ხვალინდელ პრეზენტაციაზე თუ შეიძლება რომ ორნი ვართ, ორი წარმოდგენილი და co-founder-ი რომ დაესწროს, რომ მე მისი ფიდბექიც გავიგო, თქვათ, ჩემი პიჩის შესახებ.
კი ბატონო. ხვალ რეპეტიციაზე შეიძლება.
მადლობა.
კი, ყველა ტრენერი. ბატონო? მარტო ტრენერები. მარტო ტრენერთა პრეზენტაცია და კითხვა-პასუხი. დიახ.
თქვენ თქვით რომ live stream-ი იქნებაო და სად შეიძლება რომ live stream-ს უყუროთ?
Facebook-ზე იქნება live stream.
აჰა, კი ბატონო, მადლობა.
პარასკევსაც.
ერთი კითხვაც, რომ
ეხლაც live stream-ი არის, ეს მოლაპელი live stream-ში გადაიქცევა მაინც.
მაინც დავაზუსტოთ კიდევ ერთხელ დღეს რომლამდე გვაქვს დედლაინი გამოგზავნის.
ღამის 12 საათამდე.
ღამის 12 საათამდე, კი ბატონო, გმადლობთ.
მადლობ და წარმატებებს გისურვებთ თითოეულ თქვენგან.
მუშაობ.
ვარ დავიწყო მეც ის ტექნიკურ
აუ ბათოს
კი
Yes.
Do we have your slides yet?
Yeah.